Lovely. Okay, so our agenda today is to go through the background and the framework of governmental accounting. Like I mentioned, the fund accounting that we'll be going through, the basic financial statements that you'll see in governmental financial statements, the ACFR report, going through specialized accounting applications, talking through reporting beyond the basic financial statements, going through other topics and government types, going through internal controls, auditing, and analysis. So we'll be going through the day today, going through these various areas, and then continuing on the second day. So chapter one of the Blue Book is accounting, financial reporting, and the financial statement audit. What this chapter really highlights is differentiating between the term accounting and financial reporting. Many times these are used interchangeably. People assume that they mean the same thing, but they really represent different parts of the process for the accountants or those working in governmental accounting. Accounting itself is the process of assembling, analyzing, classifying, and recording the data that is relevant to the government's financial statements. It's really assembling, getting all the data, the transactions that you have throughout the year, pulling that together to create a set of records of information that tells you, what is happening during the year for the financial statements. The government needs to assemble that data for every transaction, every event that occurs. It needs to be recorded into your data set to be able to really encompass all the activity that had happened during the year. And it needs to be classified correctly. So during the year, as these transactions occur, you have to classify that transaction or the event into the correct account to make sure that your data is being accumulated correctly. So you're recording journal entries to record that information, and that accounting really represents that assembly, the total information that you're gathering. And that's really the responsibility of management. Management has the stewardship to make sure that this is being done correctly and being recorded correctly throughout the year. Financial reporting is the process of taking the information that's already assembled, that is being gathered through the accounting process, and then analyzing, classifying, recording it, and providing it in a usable format for those who need it. So it's taking that information you gathered, putting it into a usable format that someone can understand what happened during the year. So when you're looking, for example, the detail, the trial balance, or the general ledger, if you're looking at the general ledger, it is so much information that you can't really use that to make decisions. Whereas the financial reporting, pulling that all together, becomes a tool for those to be able to understand what had occurred during the year, to be able to use it to make future decisions, future budget information decisions. So it is really these really are two different things, but oftentimes people use them interchangeably to mean the same thing when really they do represent different things. The chapter also goes through the different types of financial reporting. There's internal financial reporting. Management uses the data that you gather throughout the year for a variety of purposes. You're controlling the accounting system so you can create reports or information in a way that you need to meet the managerial needs. And that's your internal financial reporting. It may include more information related to budgets to help management monitor compliance. It might have more detail related to information that's important for management to make decisions. It might provide detail on various departments rather than general information for the government entity. And it's not subject to audit. So it's really the internal information that management is using to be able to make decisions. Then you have your special purpose external financial reporting. It's really common that a certain government entity may be required to provide financial reports to other agencies, a regulatory agency, a grantor, and then they might set the content that has to be included. So they may say, in this financial report, you have to include this type of information. And it really requires the government to tailor financial reports to the outside party to be able to provide the information that they need to evaluate or make decisions. And that's what we call the special purpose external financial reporting. And the last one is the general purpose external financial reporting, and it's the one that many of you are very involved with when it comes to the report that goes out to the public. This is general purpose. It's available for everyone to be able to use. It has to meet the needs of those who do not have direct access to the financial information. So if you're going to be putting your financial statements publicly, anybody can pull those statements. They don't have the information that you have from the management perspective, from the internal perspective, and so they need to be able to use those statements to meet various needs to understand what had occurred during the year. So that general purpose is really for anyone, for a broad range of potential users who may be looking at it. General purpose financial reporting, external financial reporting is governed by GAAP, or generally accepted accounting principles. And GAAP sets the standards of what needs to be included in the financial statements and what information should be included to present externally. And so there are three different ways that GAAP requires the information to be included, or what they call communication methods for reporting or presenting information. And you can see them on the bottom here. You have your display, your disclosure, and your supporting information. Your display is the inclusion in the basic financial statements, how it's showing up in the statements. The disclosure is how it's included in the notes to the basic statements, and the supporting information is the required supplementary or other supplementary information that you're recording in the financial statements itself. And GAAP also defines the characteristics, the essential characteristics that are included for the financial statements. So these are for each information that's being included in the statements, you need to make sure that the data is understandable, that the person can use that information and understand what had occurred. It needs to be reliable. It needs to be information that is properly documented, it's reliable, a user can rely on that information to understand. It needs to be relevant for the user. It needs to be relevant to help them make decisions. It needs to be timeliness. You need to make sure these are being recorded as they occur, not later, so that a user can make current decisions with the information you have. It needs to be consistent. So if you have two different transactions that are maybe slightly different, but there's similarities, you need to be consistently applying your approaches, your accounting principles to them to make sure the data is presented consistently in the financial statement. And it needs to be comparability. A user needs to be able to compare the financial statements from year to year and understand that the information that's included in the statements are recorded in the same way and are comparable to each other to be able to make decisions. And so now we'll talk through the display itself. The display is the items that are recorded on the face of the financial statements. And the display items need to meet those 7 financial elements that we talked about before. And they need to also include the elements that are below. So they can either be an asset, a liability, an inflow of resources, an outflow of resources, a deferred inflow of resources, a deferred outflow of resources, and net position. So these are the basic 7 financial elements that can be included in the financial statements. And the display requirement is saying that it needs to fit into one of those categories in order to be displayed into the financial statements. Then you have your disclosure. The type of information that's included in the disclosure is typically the descriptions of the policies underlying those accounts presented in the statements. So we talked about the elements on the previous slide. If you have a certain type of asset, in your disclosure, you're required to have a description of the policy for that specific asset. So what accounting principles are applied, how you gather that information, and how that information is determined at year end. You need to have detail or explanations concerning amounts presented in the basic financial statements. So again, if we go back to these elements, if you have an asset, for example, let's say fixed assets, property, plant, and equipment, in your disclosure, you will need to have a detail of what makes up that amount: land, buildings, infrastructure, and the accumulated depreciation related to that. And then you have to have information about potential financial statement elements that do not qualify for recognition. So there may be things that are not included in your 7 elements in the display, but it is important for a user to understand. So that could be included in the notes to the financial statements as a disclosure for the user to really understand what's relevant for the year. And then your supporting information is the third method of communicating information and is really to help a user have operational, economic, and historical context. It gives a user more understanding of how the government operates, the economic situation that you're in, and the background, the history of what had occurred for those financial statements so that a user can really understand and fully make those decisions. So the Governmental Accounting Standards Board, or GASB, does have certain information that is mandated. So that is what we call required supplementary information or required supplemental information, or RSI. Those are included in the statements. They're required. GASB defines exactly which schedules need to be included. So for example, if the government has a pension plan, there are certain schedules that are required and mandated by GASB. And then when we have other supplementary information, this is really anything that's not required, everything that's other besides that. But both RSI and SI, or other supplementary information, really need to link to the financial statements or the note to the financial statements. This is really meant to provide a user with information that they need to understand the statements. And really the difference is that GASB must consider it essential for it to be RSI. So what they're saying is that a user cannot fully understand that account or that element if they do not have that RSI to understand it. So if we're using pension as an example, in your financial statements, you're including your pension liability. In your footnotes to the statements, you're including your assumptions, you're including the background of the pension plan. But then in the RSI, there's further historical information. There's a 10-year comparison chart that a user would say, you need this information to understand what had occurred during the year, to understand the history and the background of that specific account. The supplementary information or supplemental information, OSI or SI, really has more detailed presentations. So there's a lot of other information that management or governance can include in the financial statements, and that will help a user understand as well additional information that they need to know about the financial statements. But GASB does not require that information, so it's not essential to be able to include that in the financial statements. And then before we jump into chapter 2, I just want to quickly show you in the sample ACFR what this looks like in the statements, just highlighting these concepts and how they connect together in a sample report. So I'll share my screen with the presentation as well so you can see. And like I mentioned before, you will receive a copy of this. So if you would like to look at this as reference, you'll receive that after the fact to be able to look at that. And so on this sample ACFR, we're going to start with the basic financial statements I want to highlight on here. But in this financial statements, like I said, the different elements that you'll see in the statements, the assets, deferred outflows of resources, liabilities, deferred inflows of resources, net position, going into the statement. I'm going to skip to the general fund so you can see, but you have revenues and expenditures. You have various elements that are included in the financial statements that are essential to be able to display the information properly in the financial reporting. And like I said, we were talking about general purpose financial reporting. So this is a sample ACFR. This is a general purpose report that is intended for a variety of users to be able to understand what had occurred during the year. And then when we flip out of the basic financial statements, you move into your footnotes. And your first footnote is your summary of your significant accounting policies. We talked about the requirements for disclosures is you need to disclose the policies that are used to support the elements in your financial statements. So typically you'll go through the background of your accounting and information that a user might need to understand what type of accounting methodology, and then you'll move into your description, your assets, liabilities, outflows and inflows, net position, and this is where you're describing your policy, cash, investments. When we go back to your statements, those are your elements, cash, investments. You're going through and describing each of the elements so that a user can understand how you get to those numbers at year end and what accounting principles that you're applying. And then after your footnotes to your statements, as you go through the footnotes, you'll of course have a lot of information, a lot of detail in there to help a user understand. Many pages, it's going through first the background and then the detailed explanation of what's making up those numbers, what's supporting those numbers at year end. And then you move into your required supplementary information or supplemental information. And this is where you have the details that are required by GASB. This is information that's mandated or mandatory for a user to be able to include. So the statement of budget to actual, as you go through each one, there's various statements that you're required to include and notes to those statements. And then we move into your, coming back, you're going to move into your other supplementary information. You have a lot of notes in this particular example, but you'll have your other supplementary information or SI that has more detail and information for a user to be able to understand what had occurred during the year and to provide additional context and information for the user. Now, flipping back to the slides. Okay. Now, next we'll talk just highlighting the financial statement audit. So when a government is required to have a financial statement audit, that is done on your general purpose statements, external financial reporting, and the audit provides reasonable assurance to an external user that the financial statements are free from material misstatement. So auditors set a materiality threshold that they're using, and they're opining on that the statements are reasonably free from that material misstatement. Now, management is responsible for financial reporting. That includes primarily first the accounting, so the transactions, the recording of the transactions, then moving into the compiling the information, the financial reporting, and putting together these general purpose external financial reports. Management also is responsible for the comprehensive framework of internal controls. So that's setting up the internal control processes that you have at your government, your payroll process, your disbursement process, and making sure that the internal controls are designed in a way to prevent or detect errors and mitigate those errors if they were to occur, as well as providing monitoring and oversight of financial reporting and internal controls. So management really provides those reconciliations, the monitoring that you're doing to identify issues, and that oversight both for financial reporting process and the internal control process for those transaction level information. So chapter 2 talks about the government environment and its impact on accounting and financial reporting. So the chapter really highlights the differences between private sector and state and local government. And the way that the information is presented in the financial statements really differs because the information that's needed is different. The entities themselves are different. And so for many people, when they switch from private accounting or public sector accounting and then they move into state and local government, it's a bit of a shift because the way that you're recording the information, the way you're reporting the financial statements is different. And we'll talk through that. And really, the reason why we have these differences is that there are environmental differences between the two sectors, and there's different information that's needed. And so the reporting difference differs because of that. And one of the biggest reasons is that there's a profit motive in private accounting or private entities, and then there's a service motive in state and local government. So the motive of how the goal of that entity is different. So a private sector entity is trying to earn a profit. They may have shareholders, and even if they don't have shareholders, they have owners, and their goal is to earn money. And they may be providing services or goods, but their goal is to earn money, to make money, and to have a profit or a net gain at the end of the year. Now, for governments as well as not-for-profits, they are concerned with providing services. And so when they're looking at financial resources, cash, investments, that is a means to an end. That's not the goal. They're not trying to make money. They're trying to provide services to their citizens. And in order to be able to do that, they need to have money or investments to be able to support those costs. So the goal of how they're trying to get to their end game is different. And that makes a difference when you're collecting money, when you're looking at receivables, your approach is going to be different. And then secondly, you have return on investment and stewardship. So for private sector entities, the key user of their financial statements are investors. Investors are looking at the financial statements to see, are they getting a return? Did they make money at year end? And there really isn't a similar concept on the state and local government side. There aren't owners. So citizens, they're quote unquote owners for the public sector, and they were the ones providing the capital of the government through taxes, through fees, but they're not gaining from that. So they're not looking at the statements to say, how did my investment earn money? And so whereas from a private sector, you're focusing on earnings per share. How did each investor earn money? How did each share earn money? Whereas a citizen might be looking at the information and saying, they're looking at stewardship is how did the government take care of that information, of that money that they had in place? How did the government use the financial resources that were received through the taxes, through the fees and fines, and how did they comply with the limitations on those resources so that those resources have a goal? You're trying to provide a service to your citizens. And so how did you use those resources that you have to be able to provide that service to the individuals? The third area is the budget versus financial plan. So an appropriated budget. So of course, governments and private sector industries do prepare budgets and not for profits as well. But the budget for the public sector is a little bit unique. So for a private sector entity, it's a managerial tool. Management creates a budget for financial planning and control, and it helps them make decisions for the year of how they're going to use the resources that they have for the end goal of creating a profit. For government entities, The budget is crucial in the process to be able to make managerial decisions, but it's also a balance between the legislative and the executive branches of government. So the executive branch is controlling the basic operations. They're making decisions or making decisions as they're using the money. And the legislative branch is the one who levies taxes or authorizes the spending of the monies. So you have this balance where it's not where management's making a budget, management spends the budget. You have different branches of the government that are making different decisions along the process. Decisions on how to collect the money, decisions on how you're authorized to spend the money. And that power of that purse, that counterbalance, is really designed to make sure that there's a balance in government and that each branch doesn't have too much control. But it means that there are constraints on management on how to spend the budget that are really unique. Private sector doesn't have that type of balance between the different branches. And then the next one is the use of more than one measurement focus. Now, we're going to talk about this in a lot of detail in some of the later chapters, but this is very unique for governments, is that the measurement focus of how you're recording the information in the financial statements differs between governmental accounting and private sector accounting. And then the fund accounting. So governments are required to use fund accounting, and this is a very unique way of presenting the information. And so that does not really occur in the private sector. And we will talk through in more detail what does fund accounting really mean and how is that presented in the financial statements or looked at in the statements. But this is the tool that state and local governments use to provide that information and report that information in the financial statements. And then the last one is budgetary reporting. So we talked about that the budget is a tool for private sector businesses to make decisions, but it really is not a direct concern to the users. We're not required to show the budget to users. When you're looking at a public company's information or a private sector business information, you're just going to see the statements and you're going to see, did they make money at year end or did they not make money? But the budget really isn't relevant to the user and they don't get that level of information. But for state and local governments, the budget is essentially a tool for the citizens to be able to say, what was the budget that management was assigned to use, that taxpayers are aware of are being used, the legislators set in the budget process, and then how did management follow that budget. And so that becomes a useful tool in the RSI, where we're including that budgetary reporting, where we look at the variance between budget and actual. And that's a tool for users to say, did management actually use the money as intended, and did they comply with that legally adopted budget? And so these focuses are very different, both on how the users will look at the information and what the purpose or the goal of the entities are. And so that really does make a difference in how you're going to report the external financial information because the needs are different and the expectations are different. So chapter 3 is going to give the history, the sources of governmental GAAP. So I had mentioned before that the general purpose external financial reporting follows GAAP, which is the generally accepted accounting principles. Now, the GFOA, the Government Finance Officers Association, is the one that has been encouraging state and local governments to issue statements in accordance with GAAP. And GAAP is really your principle, the rules that you're following to make sure that your financial statements are in accordance with standards. Now, for general purpose financial reporting, the users of these reports are the investors, the creditors, the citizens, the legislative oversight bodies. You have a lot of different users that are reading those financial statements, and they have different needs. What they're looking at in the financial statements are very different. And so the information that's included is designed to present the information in different formats to be able to help a user understand the information. And I had mentioned before that GASB, the Governmental Accounting Standards Board, that is the authoritative standard setting body for state and local governments. And so they're the ones that are setting the standards for the financial statements. You know, many of you hear the GASB statements that come out, the pronouncements that come out. They're the ones that are setting the requirements for government, state and local governments. And I do want to highlight in here because you will hear other terms that there are other standard setting bodies that the AICPA had set standards for each of the different sectors. So for private sector businesses, for not-for-profit businesses, they are following the Financial Accounting Standards Board or FASB. For federal government, they're following the Federal Accounting Standards Advisory Board or FASAB. So each one of these types of industries or have a different authoritative standard setting body to set the rules. And sometimes there's overlap. Many times they have the same areas that they're looking at, but they will each issue their own set of standards and their own information that a entity is required to conform with to present statements in conformity with GAAP. And so what we have over here is the sources of the governmental GAAP. And GAAP took time to develop. It is a process over many years where different pronouncements were issued to be able to develop the standards that you will see in the financial statements that are issued today. And so if you look at statements that are issued 20 years ago or even 10 years ago, there's different information that's required because it's a constant developing, changing standards that are being issued to help a user really clarify how information should be presented, as well as making sure the information is consistent and comparable. Back in chapter 1, we talked about display and how there's characteristics that the information needs to be comparable, it needs to be consistent, it needs to be reliable, it needs to be relevant. And that's true within the financial statements, but it's also true within the industry as a whole. GAAP GASB really wants to make sure that information across different types of financial statements are following the same standards and conforming with the same standards so that a user can really understand how that organization, that state and local government is doing, and that the information is fairly presented for a user to make decisions. And so what you can see here is these are the different levels, the categories of governmental GAAP. And these are set, like I said, by GASB. There's some other authoritative bodies that are in this listing as well, but this is really how you would follow the rules or the requirements to report in the financial statements when making a decision. So your category A, this is your highest level. These are your GASB statements and interpretations. So GASB releases pronouncements or statements pretty much annually. Right now we're up to 105. So there's a lot of statements. Some of these statements are replacing older statements. So not all the statements are currently in effect, but these are the GASB statements, pronouncements that really set the standards for your financial statements. And each one of them is related to a specific topic, and they give guidance on either how to report that in the financial statements. It might be related to a disclosure, but it really provides you with guidance on how to include the information in the financial statements. And then the second area in the hierarchy, or what we call the GAAP hierarchy, is category B. These are your GASB technical bulletins, your GASB implementation guides, AICPA literature that is cleared by GASB. So these are items where a GASB pronouncement or statement, a GASB technical bulletin, or a GASB implementation guide may not have addressed that area, and that there is guidance that is issued by the AICPA that is relevant. And so it's important and can be applied for government accounting as well. And that includes the AICPA audit and accounting guides or AICPA statements of position. And so these are what we call these category Bs. This is GASB has acted on less deliberation than the other statements. The statements are the highest level. This is what GASB spent a significant amount of time researching, developing, going to public comment, and creating a guidance that is authoritative. A category B is GASB spent less time with this information, but still has created guidance. So they are maybe a ratification of the work of others. They are documenting issues that people may have questions with and really giving guides to the users on how to handle certain accounting issues or how to address certain new GASB standards. And then the AICPA, like I mentioned, if GASB doesn't address a certain area, there may be AICPA guides that are relevant, that are important and helpful for users, and you can use that in the category B to help you make the decision. Now, sometimes there's no guidance in a certain area, a certain situation. So you look in category A, category B, there really isn't guidance for that particular question or concern you have. And in that case, there is what we call non-authoritative accounting literature. And then this is where a government needs to look at the literature that's out there and do an analysis to say which is the correct information or the guidance that they should be following. And so the information that might be relevant or literature that might be helpful in making those decisions includes that GASB concept statements, pronouncements, and other literature of other standards boards. So I mentioned before FASB, which is governing private sector and not-for-profits. There may be guidance that's available that they've issued that is relevant or helpful to help make a decision. The Federal Accounting Standards Advisory Board, or FASAB, that is providing the guidance for the federal government, may have pronouncements that are important. The International Public Sector Accounting Standards Board and International Accounting Standards Board. So while IFRS standards really do apply to international entities, there may be guidance that is helpful within a state and local government if there is no other authoritative guidance. And then any AICPA literature that is not cleared by GAAP. So the difference between category B and this non-authoritative is that there are areas that GAAP specifically or GASB specifically says this AICPA literature is relevant and you should use this. Now, sometimes there are standards or literature that they did not specifically reference, and those fall into the non-authoritative accounting literature. And then we have practices that are widely recognized and prevalent in state and local government. So things that are accepted. And then we have literature of other professional associations or regulatory agencies, accounting textbooks, handbooks, and articles. So these are really various sources of information that are important, that are relevant, that you can use after you've gone through category A and B, and now are looking into the non-authoritative literature or guidance to be able to make a decision. Now, we've gone through the background of how governmental accounting came to be and how the GAAP hierarchy is defined to apply to state and local governments. So, what is a state and local government? Who is required to follow GASB? Who is required to follow these pronouncements of the GAAP hierarchy that we just discussed? Of course, there's a similar hierarchy for other entities. So, if an entity is a private sector business, a not-for-profit, a federal agency, they have their own set of rules. So, who follows the GASB, the GAAP hierarchy for GASB? And for state and local governments, that includes public corporations, bodies corporate and politic, an entity whose officers are elected by the people, an entity for which the controlling majority of the governing body is appointed or approved by one or more state and local governments, an entity that a government can unilaterally dissolve and whose assets would revert to the government, and an entity that can enact and enforce a tax levy. As well as an entity that can issue tax-exempt debt. Now, in that case, it may be rebutted. There are times where that entity may not be considered a federal, state and local government, but that is it depending on the information and the situation. And I want to highlight these lists because for many of you, you may work for a state and local government. If you're working for a town, there's less of a question of do they fall into this category. But there are other entities. There may be entities that are legally incorporated as a not-for-profit, but they still may need to follow GASB because of the list that we have here. And if, for example, if you have a not-for-profit where the governing body is appointed by a state and local government, and the officers are elected by the people, that can fall into a state and local government requirement, and the financial statements would be required to be issued following GASB standards. So a bit unique item to mention here. Okay. And now we'll move into chapter 4, which is the funds, the fund types, and the interfund activities. And what we'll do is we'll start going through this chapter. We'll take a break around 10 o'clock, about a 10-minute break when we come back. But we'll jump into this chapter now. And really what I want to highlight here is we had talked about in earlier chapters, what is something that is unique for governmental accounting, for state and local government accounting. And one of the items we had talked about was fund accounting. Fund accounting is really unique and different, and it's information that is presented differently in the financial statements. In the accounting transactions that you're recording, it is different. And so it's very unique and really stands out from other industries. So fund accounting is a requirement for state and local governments. The fund accounting system, it's the principle of the governmental accounting and financial reporting for state and local governments, says that the accounting systems need to be organized and operated on a fund basis. And a fund basis is considered a fiscal and accounting entity with a self-balancing set of accounts recording cash and resources, liabilities, and equities, which are segregated for the purpose of carrying specific activities or attaining certain objectives. And so what funds essentially are like standalone financial statements. These funds represent a standalone balancing set of accounts that together are following in accordance with specific regulations, restrictions, or limitations. And governments may establish funds to account for specific types of revenue or specific type of activities. So, for example, a government may have revenues coming from gasoline tax that can only be spent on road repair or construction, and therefore they consolidate or they group all that information into one fund. That fund itself becomes almost like its own accounting entity. And when we talked about private sector, not-for-profits, they don't have this concept at all. It is just one entity, and that entity includes the financial information they consolidate into one trial balance, into one set of data. But in government accounting, you may have various levels of activities that are really almost self-standing. They are items that have revenue that support that activity or have certain compliance requirements or information that you need to follow. And so that fund accounting is required so that you can see standalone how that activity is doing on its own. Now, that helps financial statement users. If they have an interest in a specific activity, they might say, okay, well, let's look at that fund. How is that fund doing on a standalone basis? Now, when this first started happening with fund accounting, you would have separate bank accounts. So you'd have this account, this cash account. It would really operate almost like its own business. But now with, it's more common that we don't have multiple bank accounts. We don't eliminate that need. And the funds are really data sets within that government accounting system. And you apply or allocate cash to different funds. All the activity might be paid out of one fund and then it's allocated to the other funds. So it's really an accounting tool to create these separate data sets within the financial statement system. Now, the number of funds principle is the third principle of the fund accounting, and it states that government units need to establish and maintain the funds required by law, and only the minimum level of funds should be established. And the highlighting or the key factor for this is that having too many funds can create inflexibility and complexity and inefficient information. And so sometimes users might think, let's have separate funds for everything. That'll help us really track every activity or every detail separately. But that doesn't really provide information that's usable or helpful to a user of the statements. If you were to pull open a financial statements and there were 25 fund columns across the statements, it would be hard to follow the activity. And so for the purpose of financial reporting, we're really establishing and maintaining only the minimum number of funds that are required by law and sound financial administration. So there are a certain number of funds that are required, that are legally defined you must have. And if you have those type of activities, you must have those funds, and we'll go through that. But then beyond that, the government has to determine, using sound financial administration, what is relevant to the user and what is the minimum level that helps the user make decisions. And we talked about back in the first chapter the differences between accounting, the collection of the data, and the financial reporting, the aggregation of that data into a financial statement for decision making. So the users of those two are different. And so for accounting purposes, you may have more levels of detail, more higher level of detail, higher level of funds to be able to have management make decisions. But for the financial reporting purposes, it's typically a lower level of detail. And so you might consolidate those funds into a single fund for financial reporting purposes. And you commonly see that, and we'll talk through this later on, but as an example, you might have a capital projects fund on your financial statements. And within that capital projects fund, you'll have one column on your statement, but in the accounting detail, you may have multiple funds. You may have various sources of revenue to support different capital projects. And you might want to be able to track to say, how is that money being spent? What's your bottom line, quote unquote, for that specific capital project? So for accounting purposes, you may have a lot more detail in those fund levels than you would on the financial reporting side. So now we'll talk about the types of funds or the categories of funds. So for state and local government, we have three broad categories of funds. And there are differences between them, and we'll talk through that. But the first is governmental funds, second, proprietary funds, and third is fiduciary funds. These are broad categories of funds, and within each of these fund types, there are different types of funds that are applicable. So starting with governmental funds, these are used to account for activities that are primarily supported by taxes, grants, or similar revenue sources. So these are funds that the government is collecting that money through tax levies, through grants that they receive from other federal entities, other state and local entities, or federal agencies themselves, and similar revenue sources. Proprietary funds are used to account for activities that receive significant support from fees and charges. So these are activities that you're actually charging a fee to a user and you're collecting that money to support that fund itself. And then fiduciary funds are used to account for activities conducted by a government or component units for the benefit of those outside of the government, and as well as for pension and OPEB arrangements. So each of these types are different from each other, and the way that we account for them are different as well. And so what we talked about, these are your broad categories. And then we're going to move into the specific fund types or details of those categories. So your first category we talked about was governmental funds. Reminder that that is funds that are supported by taxes, grants, and other similar revenue. Now, there are five types of fund types of governmental funds that are typically included in the financial statements. First, you have your general fund. Now, this is like a main operating fund. This is really all encompassing and it essentially accounts for everything that is not reported in another fund. So it is a catch-all of everything else that doesn't specifically relate to other funds. Now, this is important. A government can only report one general fund. You cannot have more than one general fund in your financial statements. However, there are governments that have detailed funds. They may have smaller funds, internal funds that consolidate into a general fund, but on the report itself, you need to only be reporting one general fund column. And then we have our special revenue funds. These are accounting for proceeds of specific revenue sources that are restricted or committed for a specific purpose or expenditure other than debt service or capital project. And so the funds that are being gathered in a specific case, whether it's other revenue sources, whether it's tax types, they're restricted or committed to specific types of costs. So that includes these specific expenditures are designed to help determine and demonstrate that the resources are being used for the restriction that are in place. And so that restriction needs to be placed by an external or legislative body. It can be replaced by credit or imposed by an external party like a creditor, grantor, contributor, other governments, by legislation, or by the actions taken by the highest level of decision-making authority within those governments. And then there needs to be a justification to use special revenue fund, not just a limitation on revenue. The resources have to be derived from one or more specific revenue source that is being used for that specific commitment or expenditure. So, for example, a government might say, I want to create a special revenue fund because this resource coming in is limited to a certain activity. But that limitation alone may not justify the use of the revenue fund. You need to have both the restriction or the expenditure that's restricted for a specified purpose, and then the proceeds of that specific revenue source needs to be restricted or limited to that purpose itself. So, for example, if you have a surplus in the general fund, that doesn't become a revenue source where a city, a government, a town might say, we're going to commit some of that surplus for a specific cost. That is not a special revenue fund. A special revenue fund needs to be a special revenue source coming in that is restricted for a special type of expenditure. So, for example, I mentioned this before, but a gasoline tax. So if a government is charging gasoline tax and that needs to be reused for certain types of repairs, that might become a special revenue fund. If you have a water fund or a sewer fund where you are, that's proprietary. If you're going to be specifically talking about governmental, it has to be a tax type that is coming in. So a tax that you're charging that is being used for a specific purpose. And then you have a debt service fund. Now, your debt service fund is reports and accounts for resources set aside for your principal payments. This is for the debt that you have in place that is reporting all the activity that is related to the debt fund. And many times governments will accumulate resources in anticipation of debt service payments. So sometimes it's voluntary. If they have general obligation debt, they may be setting aside funds to pay for those payments. They might have contractual obligations if it's revenue supported debt. And that debt service fund accounts and reports those resources that are restricted, committed, or assigned to pay for those principal and interest payments. And so it really helps a user understand what cash is being gathered to pay for your future payments and what investments are being gathered to pay for those future payments that are going to be coming out. Now, you also have a capital projects fund, and a capital projects fund is often distinguished from your general activity because you have capital activities that are being paid for out of your capital project. And the capital project funds reports financial resources that are restricted, committed, or assigned for capital outlays or the acquisition and construction of capital facilities or other capital assets. And governments really want to separate the capital activity to avoid distorting data. So capital projects are very expensive and there may be spikes. So you may be spending in one year, you're building a building, so there's significant costs. And the next year, you don't have much. You might be doing repairs that are going out of your general fund and you may not have the capital activity, capital outlay. that you had the year before. And so that, if it is in your general fund, it might spike the data or distort the data because one year will be significantly higher, one year will be significantly less. And so the capital projects really pulls that information out and reports it in the capital projects fund so you can see the major projects that are being done. Now, I want to mention that routine capital outlays that are smaller projects, general government costs, they might be reported instead by function in the general fund. So related to general government, public safety, parks and rec. The capital projects fund is really for major projects and acquisitions, building new buildings, purchasing really large infrastructure and equipment that may be budgeted for, and you have financed specific resources to be able to do that, debt, things that you're doing to be able to support that cost. So it is really standing alone to provide that information to a user so that they can see the activity on its own. And then permanent funds are used to account for resources that are restricted to the extent that only earnings and not the principal can be used for the purpose of supporting that reporting government's program. So, for example, you may have a perpetual care endowment for a municipal cemetery. You have specific endowments or costs that are supported or intended to support certain activity, and you're not allowed to use the principal, you can only use the earnings. And in those cases, they'd be recorded in a permanent fund and they're restricted for use, and you can only spend that money as required or allowed by that arrangement or agreement. Now, permanent funds is permitted rather than mandated. So permanent funds are mandated rather than permitted. So a permanent fund, if you have this activity, you must show it in a permanent fund so that a user could be able to see that information and have it separated from the rest of the financial statements. Whereas debt service funds or capital projects funds is not mandated for financial reporting purposes, but it is allowed. So if a government doesn't have debt, you won't have a debt service fund. If you don't have significant capital projects, you won't have a capital projects funds. Some governments don't have capital projects funds and they report all the activity through the general fund if they're not doing significant costs. Smaller repairs, maybe they don't own property, and so they're renting the facilities, and so their costs are smaller. Vehicles, repairs that might be expensed, or things like that, where they might not need a capital projects fund. However, if you do have a permanent fund activity, you must have a permanent fund on the financial statements itself so that a user can see that activity. Now, I'm going to share the slides for the ACFR now, just so that you can see that as well, highlighting how that presentation shows on the financial statements. Okay. All right. So when we're looking at the basic financial statements, we're specifically going to be talking about the fund level. So I'll be focusing here on the governmental funds, which is the section that we're talking about. So that in here you have the governmental fund balance sheet, you have the general fund like we spoke about. You have, in this case, you have a CDBG, block grant, which is a special revenue fund. You have a capital projects fund, and you have a debt service fund. You also will show the non-major funds, and this is based on the dollar value that are not considered major for presentation on the face of the statements, which we'll talk through distinguishing that in later slides. But this is really highlighting, in this case, this sample government has 4 of the 5 types. They don't have a permanent fund, so they're not required to show it separately. If they did have a permanent fund, they would be required to show that presentation. But here they have your general fund, special revenue, capital projects, and debt service. And when you look at special revenue fund as an example, here you have the same funds here on your statements of revenues, expenditures, and changes in fund balance. You're really highlighting that the special revenue fund, the revenue that is coming in, intergovernmental revenue here, is designed to support a specific purpose. And so it's fairly common on your general fund, it's all your general activity, your general government, your public safety, basically everything that doesn't fit into these other categories. But your special revenue fund, the revenue that you're collecting is designed to support a specific cost or restricted for a specific cost. Capital projects, you're supporting capital outlay. So your expenditure side is going to be the costs related to capital outlay. And then in this case, there was some debt costs related to those. So you would have some issuance costs related to the capital projects itself. Your debt service costs is all your money coming in is designed to support the principal payments, the interest payments, new issuance costs. So each of these activities is really showing you on a standalone, a balancing set of statements. You see here these balance to be able to present these statements if they were to stand alone, the activity that were to occur for these statements themselves. And then consolidated there, the governmental activity or governmental funds that we're seeing on the financial statements. So before we go into the other fund types, we'll take a 10-minute break now. It's about 10 o'clock now. So let's return back at 10:10 and we'll continue going through the fund types and going through the detail. Okay, so we have just gone through the governmental funds. We talked through the general fund, special revenue fund, debt service, capital projects, and permanent funds. And so jumping back into the slides, we'll be moving into the next types of funds, the next broad category, which are called proprietary funds. And proprietary funds are classified into two fund types. We have enterprise funds and internal service funds. Now, enterprise funds are activities that are paid for by external users that are charged through fees to a user. So essentially, you're charging a fee for a service or a good, and you're providing that service to a user, and it would be recorded in the enterprise funds. Now, if you think about this, this is more similar to a business. And so a lot of times you'll hear people call these business type funds, which is really what they're called in the government-wide activity. But it's really because the activity is supported through fees that are charged to a user to provide the activity themselves. Now, a activity must be accounted for in an enterprise if there is outstanding debt that is backed solely by those fees and charges, if there are laws or regulations in place that those fees and charges must be used to recover certain types of costs. And so, for example, you might have a water or sewer fund that the fees that you're charging to the user are legally required to support that cost, replacing the infrastructure, providing the services, salaries, etc. And so that would be required to be accumulated or shown separately in that enterprise fund. If there's a pricing policy that the fees and charges that are used to that you're being collected are used to cover those costs, and those prices are set, that is also required to be shown in an enterprise fund. And the goal of an enterprise fund is to really highlight how those fees and charges are enough to cover the costs of providing those goods or services. Now, a lot of times the fees and charges are not enough to cover. So you may see an enterprise fund, let's say a public transit system that is being shown an enterprise fund, that they might get half their revenue through fees and charges, but then the other half is being covered by a transfer from the general fund. Now, for a electric utility, typically it is mandated to be shown as an enterprise fund because there's a legal requirement that the funds must be used to pay for the cost, and there's a pricing policy set by the governing body to recover those costs, whether it's a per usage unit cost, and that's being charged to the individuals or the citizens in that area. So they'd be required to be shown as an enterprise fund. Now, GAAP does specify that there are two instances where you must use an enterprise fund. That's the public entity risk pool and a state unemployment compensation benefit plan. So for a public entity risk pool, if the sponsor is the predominant participant, then it has to be classified as an internal service fund or in the general fund of the sponsor's report. And then the state unemployment compensation benefit plan, any administrative costs related to that plan need to be reported in the general fund. But if its government does have those two types of activities, they are recorded as enterprise funds as mandated. Now, in the private sector, we had talked about the different types of state and local governments and what qualifies as state and local government. Sometimes there are colleges and universities that are showing financial statements that are enterprise funds. So they might be supported by the government. They might actually be an entity or component unit of a government, and their financial statements are considered enterprise funds because they're charging tuition and fees to the students, and that's being used to cover the costs of those providing the activities. Now, the second type of proprietary fund is the internal service funds. And that is reporting activities that provides goods or service to other funds, departments, or agencies of the primary government and its component units on a cost reimbursement basis. So essentially, they are providing services to other funds or other departments within that government. So an internal service fund may have a shared pool that they allocate costs to different other funds within the entity. They might be charging costs to the general fund, but essentially it's consolidating all the internal information, the charges that are being done within the government. Now, there are some limitations on the use of an internal service fund. The government itself must be the predominant participant. So it is fairly common that internal services funds might use excess capacity to provide services to outside parties. So depending on the type of fund it is, let's say, for example, a printing service. So they might be providing printing services to different agencies within the government, but they may also provide a charge or an availability to the public and to, public corporations to use those services. If the government is not the predominant participant, it's not considered an internal service fund, and it would need to be an enterprise fund, essentially, that's making money. And the fund must function on an essentially break-even basis over time. So an internal fund, service fund by definition is essentially a cost recovery. So you're charging one fund to cover the cost of what it would cost to provide that service to that fund. So you're not trying to make money on an internal service fund. Now, there could be that there's a surplus or deficit in a given year, but if you have continuing growth in your surplus or deficit over time, that is not compatible with the type of fund that this is. It is not expected, and that would stand out to a reader that there's something wrong with how that fund is being used. Because essentially it is meant to be cost reimbursement. That is part of the purpose and the definition of it. And that if it starts growing a surplus or growing a deficit, then it is not being reimbursed for the cost properly that it is providing. And then the next type is a fiduciary fund type. Now, we mentioned earlier when we were talking through the fund types back in a few slides, we were talking about that fiduciary funds provide benefit for those outside of the government or certain pension and OPEB arrangements. So essentially, a fiduciary fund is it's really operating differently than the governmental and the enterprise funds. Those both governmental and enterprise funds are providing services, gathering revenue for the purpose of that government. The fiduciary fund activity is where the government has control over these assets, but they are providing or maintaining those assets for an external body. It could be a fiduciary component unit that they have fiscal accountability for the entity and they would be holding that money for them. They could be holding that money for those outside the government. So, for example, a pension OPEB arrangement. They're holding cash investments for the future payments out for individuals for pension and OPEB transactions. Now, there are four types of fiduciary funds, four categories that are allowed to be recorded. So the first type is a pension and other employee benefit trust fund. So this is your pension and your OPEB trust funds. Now, these are pension, OPEB, and other benefit plans that are administered through a trust that the government is holding the assets and has fiduciary responsibility for maintaining the assets. Now, one thing I do want to mention, because you see the word trust in three of these, there are some requirements about trusts and if they meet certain criteria to be included in fiduciary activity. So the first one is the government itself cannot be a beneficiary of that trust. The purpose of the trust is to provide benefit to external individuals. The trust assets can only be used to provide benefits to the recipients in accordance with the benefit terms, and they need to be legally protected from creditors of the government. So essentially, like we mentioned before, the government is holding that money on behalf of someone else. Legally, it cannot be used to support the government. It needs to be protected. If the government were to have creditors coming after them for payment, this money is not the government's money. They're holding it, they have responsibility to protect it, and it cannot be used to pay back debt for the government. Now, for pension and other employee benefit trust funds, now it is very common that governments provide pension benefits to their employees, as well as other post-employment benefits, which covers the cost of retiree health care. And these are administered through trust funds or trusts that are controlled by the government, and they get reported in the financial statements as a fiduciary fund where they're showing the assets that are being held. To be a true trust fund for pension and OPEB, the contributions made to the trust by either employees or other contributing entities must be irrevocable. So they're not going to be taking that money, you're not losing it once it's in there, it's irrevocable. And it can only be, the assets can only be used to provide the benefit for the pension or OPEB benefits to the plan members in accordance with the term. And again, the plan assets need to be protected by the creditors of that government. So, for example, pension plans, like we said, they're fairly common. The government sets up a pension plan for employees. They might be contributing 4, 5, 6, 7% to that pension plan. Those contributions that the employees themselves are making into the plan are irrevocable. The money that is consolidated and growing, it's invested, it's continuing to grow, can only be used for the benefit of those individuals that are enrolled in the pension plan, and the assets are protected from the creditors. And similarly, an OPEB plan, where people may be contributing to the OPEB plan themselves, but they might not be. Those assets might be contributed by the government itself. They are protected, they are being used for the purpose of providing retiree health care, and they cannot be used for anything else. An investment trust fund is a government, there it is common that governments will pool resources for investment purposes. Sometimes the state and counties sponsor those arrangements and they create what's called governmental external investment pools. And that's where they're creating a pooled investment to help maintain and grow money. And the sponsor itself might participate in the plan. But these pools are administered through a trust, similar to the pension and trust funds, and there's a commingling of assets. So you have assets that are available to all participants in the pool. Those assets are not assigned to an individual participant. If they were separate, so if we were to say a state had a separate pool or a separate trust fund for each county within that state, they would be individual investment trust funds. But if they are not separate, then they will be commingled and they would be a portion that's allocated to each of these funds, and it'll be one investment trust fund. There needs to be external participation. So only the investments that are held on the behalf of others are reported in the investment trust fund. If the primary government is putting money in that trust as well, even if it's commingled with it and invested with the external portion, it's not considered fiduciary because it's being held on behalf of the government itself. So then it'd be recorded in the governmental or proprietary fund or as a payable to a discretely presented component unit if needed, if it's a component unit that's presented in the statements. So that is fairly common when you have these investment trust pools. A lot of times the sponsoring government doesn't have money in the fund, and so therefore their portion would be on the financial statements. So we pulled out, shown in the proper government fund for their government or the component unit payable, and then the true investment balance would just be related to those that are external to that government. There has to be an investment purpose. It has to be the generation of income. That is your primary objective. You're trying to earn money through market growth and gain. And it needs to provide benefit to external participants. So you need to share the earnings with those individuals and provide those earnings to them. Now, your investment trust fund, like I said, it's reporting only the external portion. It only reports the portion of the pool that belongs to the external individuals. And then if you have any internal investment pools that are remaining, those, and where you see this a lot is pooled cash and investments, is that it's not a cash account that's assigned to the general fund. It's a pooled cash account or investment account that is allocated to each of those funds. And then you'll see it showing as a pooled cash line or pooled investment line rather than a separate fund of its own right. And you'll see that within the various fund types throughout the financial statements. Now I'm going to switch over to the financial statements now just to show you how that is presented. And for those of you who do have the statements up, we'll just start since we didn't go through the proprietary. We'll just look at that quickly and then we'll continue on with fiduciary funds. But what you can see here on the proprietary statements or proprietary funds, we have our statement of net position. We are on page 41 of the PDF. And you can see in this case, they have two enterprise funds, water and transit, where the activity that you're collecting here on the statement of revenue expenses and change in net position include operating revenue, which is charges for services. So you are collecting charges. For example, if we look at water, you're collecting $9 million in charges for services of metered water sales, and then you're using that to support your operating expenses. So you're using that to report your salary costs, materials, contractual services, depreciation of your fixed assets. And then down here, you have your net position, and you have here an increase in net position. Most of the time, the proprietary funds are self-sufficient. You'll see that a lot. They have their own investments, so they may be earning money on their own investments. In this case, they have their own cash and investments here, so they're earning on that. Now, the transit fund, I do want to point out here something that's unique about that is this is fairly common with transit funds, is you have your revenue here, you have your passenger fares, your contract transit, some miscellaneous revenue, but you have about 930,000 in revenue. When you look down at expenses, you have 5.9 million of operating expenses. So that is almost a $5 million loss in this fund. Transit funds are often supported through non-capital subsidies, in this case, which is the transfers in. I do want to mention that this specific example, this specific ACFR that we're looking at is implemented through GASB 104. So GASB 103, which is going into effect this fiscal year, these changes are reflected in the statement. So if you're looking at statements that you may have seen from last year, this section is new, but it does show the transfers in of 3.7 million. So while this fund does have an operating loss here, with all non-operating activities, you end up with a positive increase in that position. So this fund doesn't end up with a loss, but it is not directly supported through its charges for services. But many governments do elect to show transit costs or similar types of fund as enterprise funds because the revenue that's being collected is designed to cover those costs or to support those costs. This sample AFR has an internal service fund as well. Now, when we looked at the slides, we talked about internal service funds as being a governmental activity. They are recorded on the business type activities, but they're considered governmental activities here. So they're reported in the proprietary fund statement as a governmental activity. Now, moving to fiduciary funds, I do want to highlight on here. Here's your statement of fiduciary net position. You have your assets, their liabilities, and your net position. Now, for fiduciary funds, you're essentially collecting money to hold for the benefit of others. So where you see the largest amount of assets, or really the only assets, are typically cash investments and receivables. So receivables are usually receivables to your cash and investment accounts. And then essentially, you will see more investments than cash because the purpose of this is income generating. You are trying to raise money or earn money for the benefit of those fund types. So we have talked about, so far, we have talked about the pension and OPEB trust funds and the investment trust funds. Now, in this particular example, pension and OPEB trust funds are recorded in one column. You'll see that often, but what you will see in a lot of statements in your supplementary information, you'll see a breakdown of what's related to pension, what's related to OPEB. You may have multiple pension plans, so oftentimes there's a consolidating schedule to build up to this number. And typically you'll have some liabilities, but the bulk of your net position is going to be sitting in your asset side. And when you look down here in your restriction, in this case, 22 million is restricted for pension, 1.3 million is restricted for OPEB. So your post-employment benefits other than pensions. So you're really holding that money for that restriction. And similarly on the investment trust fund, in this case, 172 million is restricted for the pool participants. And this is just representing the total amount that is related to the external individuals or external bodies. When we look at these statements here, don't have pooled cash, but where you would see this is you have your cash account here that are held by the individual fund types. You may have pooled cash or investments in pooled accounts that are held for the benefit within this same investment account that is showing on your fiduciary statements. And so in this case, the full amount is really being held for external individuals. Okay. Jumping back to the slides. So the next type of fund that we have is the private purpose trust fund, which are used to report all fiduciary activities that do not meet the requirements that are reported in pension or investment trust funds, but do meet the requirements to be recorded as an other fiduciary trust fund. So this is a little bit different than a permanent fund because a private purpose fund could either be expendable or non-expendable, or what we'd call permanent, quote unquote. We're just using the terminology in a different way. And a private purpose fund can be used to report a sheet property. It can be used to report really any other investments or accounts that are being held that don't fall under the definition of the investment trust fund or the pension and OPEB. So more of a general category. You don't see this in every ACFR, but only if it's applicable, it'd be reported in the financial statements. Now, the custodial funds This is the only fiduciary fund type that can report assets of fiduciary activities that are not in a trust or another fiduciary trust. So, an OPEB or investment trust or other fiduciary. So, this is a catch-all. It basically reports all fiduciary activities that are not reported in the other three categories, and it gets reported in this custodial fund. Now, we said fiduciary funds cannot report any government's own resources. So if you have custodial funds, you should not be using them for grant-related resources that have not yet been expended. Those go into the governmental fund or proprietary fund activities. Now, it is common that from internal reporting, internal accounting, sometimes governments will use custodial funds as a clearing account. So for its resources that are received but not yet allocated for the individual funds. But for external financial reporting, they need to be moved out because the custodial funds cannot record or report the government's own resources. So it needs to be what's left over, activities that are exclusively for the benefit of those outside of the government. Now, want to highlight some of the definitions between activity that is between the government itself and outside of the government. So, when you talk about activity that's within the financial statements that are inside the primary government, we use the term interfund activity. These are activities that occur between funds within the government itself. There are two types of activities that you may have. You can have reciprocal interfund activity and non-reciprocal interfund activity. So interfund means in the government, transactions are outside of the government. Now, in a reciprocal interfund activity, this is where you have an equivalent of exchange or exchange-like transactions. And that's more similar to transactions with an external individual or external body. Within reciprocal, you have interfund loans and interfund services provided and used. Interfund loans are often called advances. It's when an asset of the lending fund is recorded, a receivable, and a liability is recorded for the borrowing fund, a payable. So one fund is loaning money to the other. Now, these are interfund activity. So within the fund levels itself, the statements must balance a standalone activity. So you do have a receivable. One fund is receiving cash from the other fund. So they're recording the receivable and the payable, but it's not an investment. So it's not debt. You can't have debt between funds. It's typically a loan from one fund to the other fund. And this is really common. So a general fund might make a loan to an enterprise fund and they would record a receivable, they're recording the receivable in the enterprise fund, or on the general fund because they gave the money out, they're reducing their cash, the enterprise fund receives cash, records the payable. Now, when you have a loan that there is no expectation or reasonable expectation of repayment, it is not considered a loan. So you do see sometimes that funds will set up loans but there really is no repayment time frame. And in that case, it should not be a receivable in the books, it should not be a payable. It's really a subsidy. One fund is subsidizing the other fund's activity and it needs to be transferred out of the fund balance and not recorded that way. So typically you record that as a transfer from the fund from the fund that made the payment to the fund that received the payment. That becomes a transfer. Now, how do you define whether it should be a transfer or a loan? GASB, the authoritative accounting standard, says that the repayment needs to be expected within a reasonable amount of time. So if there is no repayment expected, it is not a reasonable amount of time. It's really a subsidy, a transfer from one fund to the other, helping cover those costs. Now, you may see this being recorded as advances or due to other funds. So you'll have a due to in one account, a due from in the other, and they net out to zero, and it's the interfund activity. The second category is interfund services provided and used. Now, sometimes one fund will sell goods or services to another fund. So, for example, you have a water fund and you have a parks fund. So that water fund is selling water to the parks department, and there needs to be an exchange for equal or almost equal value. These are considered interfund services provided and used, and they need to be treated as if they were accounted for with an external individual. So just like they would sell water to an external individual, the water department sells water to the parks department. Now, overhead allocations are not considered interfund services provided and used. They're not a programmatic activity. So that's just an overhead payroll, use of space. That's not services they would provide to the other individuals. the fund needs to be in the business of selling those services and supplies. So a water fund is selling water to external individuals, therefore they can provide those goods and services to another fund. Now, the next type of interfund activity is the non-reciprocal interfund activity. These are situations or activities that do not involve the exchange of equal or almost equal value between funds. So it's essentially a non-exchange transaction between two different funds. And there can be two types as well. There can be interfund transfers and reimbursements. A transfer is a flow of asset, goods, cash, without an equivalent flow of assets in return. And the example that I had mentioned before, which we'll see, is the operating subsidies. For example, transit is a common one, is the general fund may be subsidizing the cost of that fund, of the transit fund, and they're not loaning the money. They don't expect repayment, and there's nothing that's provided in exchange for that transaction. So that becomes an other financing source and use for governmental funds, or prior to GASB 103, it would be a non-operating revenue and expense, and with the implementation of GASB 103, it's typically a non-capital subsidy. And so you're transferring that subsidy or that transfer, depending on which pronouncement you're following, and you're transferring that money from one fund to the other, no expectation of repayment, no transfer of goods or services, and it's just helping support the cost of that fund. And this is fairly common. You do see this within financial statements to support costs of certain activities. Now, an interfund reimbursement is a repayment from the funds responsible for a particular expenditure to the fund that initially paid for them. And so where you see this a lot is the general fund often will pay bills on behalf of other funds. So the operating cash is usually flowing through the general fund, and so they might pay a bill, and then a portion of it relates to the special revenue fund. And when that occurs, you would have this operating reimbursement or this interfund reimbursement where you're paying back the other fund for the portion of the bill that was paid on your behalf. And so you'll see those flowing through the interfund activity, and you'll see that flowing through the non-operating revenue or expenditures and or through the subsidies, the transfers between funds, depending on the situation. So I'm going to share the screen again so we can take a look at some of the activity in the ACFR itself. Okay. So looking at the mass transit one as an example, this is a great example for seeing this. But what you can see here, like I'd mentioned before, you have this transfers in, and again, this has GASB 103 implemented, so it's flowing through the non-capital subsidies. But 3.7 million is covering the cost of that transit. And when we move up to the governmental activities, the governmental funds, you're going to see transfers out. So you have $5 million here coming out of your transfers out account. Now, it's more common, and like I mentioned before, it's the other financing sources and uses. The general fund often subsidizes more of the other funds. So it's not going to tie exactly to the amount that's being received by the transit fund, but typically the general fund is the one that is subsidizing something like a transit fund. And then that transfers out as being used to support other funds as well. So it potentially could be supporting capital projects, it could be supporting debt service, but it's flowing through that transfers out activity. And then what you can see on the balance sheet or the statement of financial net position for the proprietary funds. So here you have this line, this due from other funds. This is picking up your intercompany activity. So they have a due from or a receivable of $12,000 in the transit account. And then on the liability side, you will see due to other funds if they have any. So in this particular case, these funds don't have any, but since we have a due from, you need to have a due to. They have to balance out. All the intercompany activities are balancing transactions so that each fund can stand alone on its own. And so down here, you have a due to other funds. Now, the general fund has the biggest amount of 335,000. You have some non-major, which is made up of multiple funds of 432,000, 15,000 from CDBG. So each of these have due froms, and then up here you have due tos. And some of them you can tie exactly. So if you can see here, the total non-major funds here, due to other funds, that full amount is owed here to the general fund. These two transactions balance out. Well, almost balance out. It's a $3,000 difference coming from another fund. But 432,148, 435,148, these are making up the primary portion of this. Down here, you have due to other funds of 335,895, and then a due from other funds and capital projects of 335,895. So individually, they might not tie out. In this case, they do as an example. But then in the footnotes, the disclosures to the statement, you would include the interfund activity so you could see the detail and how it all balances out to zero. Some of the common errors that I see on there is sometimes the interfund activity doesn't balance. And so that will make your statements not balance and cause some reconciling issues throughout and the government wide as well. So those interfund activities really need to be standalone entries. They each fund has to balance on its own, and then the interfund activity has to balance across all the funds to pick up all that activity. And like we mentioned before, some of these could be exchanged like transactions. So capital projects and general fund is usually a non-exchange because they're providing services or cost to cover the cost of capital projects. But for some of the funds, they may actually be providing services to each other. And therefore, you would have a due to, due from that would be an actual representation of an exchange transaction and providing services. Now, in this case, the internal service fund doesn't have any due to, due froms, but oftentimes you will see that with other funds to be able to see that activity from the internal service providing goods and services to other funds or other activities within the government. Now, I will mention you typically don't see these activities flowing through the fiduciary funds because the fiduciary funds are representing the assets held on behalf of others. So they're usually not borrowing money from other funds. You'll have a due to local governments, but that represents external bodies. And so that doesn't represent internal transactions or interfund activity. Where you see that the most is in the governmental activity and the proprietary activity, where you see that interfund activity. Okay. Now, before we move into the next section, does anyone have any questions about the fund types? Okay. So we're now moving into chapter 5, which is the government-wide financial reporting. So we talked a lot about the fund level accounting. That's the required funds for government statements. But now we have a bit of a unique presentation. We have what's called government-wide financial reporting. The government wide is pulling everything together. The purpose of it is to present the financial position and the operating results of the primary government, of the total government. So for the fund levels, we're presenting each fund separately. For the government wide, it is everything all together. We're pulling it all together to show the full operating results, the full financial position of that primary government. The purpose of this is to provide the users of the statements with operational accountability, helping the user understand the total accountability, the government's responsibility to report how they've met their operating objectives efficiently and effectively, using all those resources available for that purpose, and to show can they meet those objectives for the future? Do they have future plans to be able to do that? Now, the two essential facets of accountability in the financial statement, which Gatsby does say is an objective of financial reporting, is that the financial statements have to represent or show accountability in two ways. The operational accountability that we talked about, how you're meeting those objectives, and then the fiscal accountability is how they've complied with public decisions concerning the raising or spending of public monies in the short term. So how they're spending their money and are they spending it properly? And so a user needs to be able to look at the statements and meet both levels of accountability. Now, fiscal accountability is more short-term in focus. How have you spent your money and met your budget in one budgetary cycle or 1 year? How are you spending it? The fund level detail is really better to provide that detail. It can show you on a much more detailed level. It can show you the compliance with different requirements within that year. But operational accountability, you need that bigger set of detail. And so that government-wide statement is to help you look at that information and provide it with a higher level of detail to be able to see that operational accountability. So again, fiscal accountability is met through your fund accounting, and which is reported on a modified accrual or cash basis, which we're going to talk about. And operational accountability is your entity-wide statements, as well as your enterprise funds, which are both reported on a full accrual basis. Now, the government-wide statements are going to help a user to be able to understand the true financial picture of the government as a whole, including capital and financial assets and long-term assets, as well as short-term liabilities. Now, on the financial statements, the government-wide financial statements, you want to be able to determine whether the entity is able to continue to meet current levels, to meet its obligations as they become due, looking at the operating result of the entity, looking at economic costs, the cost of services, and assessing the efficiency, effectiveness of the operations. So GASB really requires that both of these activities occur. You need to have a fund level and you need to have the entity-wide statements, the government-wide statements, so that a user could have a full comprehensive financial reporting model. And that is really going to answer all their questions and provide the information in different format to be able to effectively make decisions about the entity. Now, the government-wide financial statements, they include two columns. They have governmental activities and business type activities. And I want to highlight on here because I think this often gets mixed up is that we have governmental funds and we have governmental activities, but there are some differences in the accounting, even though they're using the same terminology. And then we also have our business type activities. And typically all your governmental fund data that we talked about, general fund, special revenue fund, etc., are incorporated into one column on the government-wide financial statements, and all your enterprise data is incorporated into one column in the business type financial statements. Now, some of the differences between fund accounting and governmental accounting is the differences in the economic resource measurement and accrual basis of accounting for governmental activities. So this does not apply to business type activities, so we're going to focus more on the general fund. Now, the government-wide is using what we call an economic resources. We talked about before in an earlier slide, the goal is to show your operating accountability. We're focusing on your economic resources, how you are using the funds, how you have a future use of the funds, and you are using a full accrual basis. General funds or governmental activity funds, those are using a modified accrual basis. The focus, like we talked about on the earlier slide, is really focusing on fiscal accountability. And because of that, we're focusing on how you're using your money on a budgetary basis, usually in one cycle. So it's a short-term focus. So the financial statements, while we record statements using accrual basis under GAAP, fund level statements are recorded using modified accrual. And we're going to talk through that in a little bit later, but there's a big difference between how the information is recorded in the two different sets of financial statements. On the government-wide statements, you're also eliminating your interfund activity. So on the fund levels, we talk through the due to, due froms, the transfers in, the subsidies, but all that activity is being eliminated in your government-wide, and the government-wide statements are to show you the true activity of the government as a whole. Fund level, it helps you provide detail, but as a whole, the interfund activity isn't really relevant, so that gets eliminated. And then direct and indirect costs that are included as part of governmental activities are allocated to the different functions so you can determine how to show them or how to present them on the statements. You also may need to include blended component units that are recorded in the statements. You consolidate the governmental and enterprise fund data. You consolidate the internal service funds in the governmental activities for government-wide purposes, and you record them in the statements. So there is a very different presentation between the two statements. And I really do want to highlight again the first one, which is the conversion to economic resource measurement and accrual basis of accounting, is that because you're showing a long-term focus or economic resources measurement focus, you need to include all assets and all liabilities so that a user can understand for the future all information that's important. Whereas on governmental funds, you're focusing more on near-term liquidity. And so therefore you're focusing on current financial resources, financial resources measurement focus that you're using, and you're only including assets that are in the current focus. So for example, on the government-wide statements, you would include capital assets or debt. But on the general fund statements, you don't record that debt because you're focusing on the current financial resources and you're not going to be paying out debt with current resources, and capital assets are not using current financial resources. So they do not record the same activity. So governmental funds are what we call current financial resources measurement focus or near-term liquidity modified accrual basis of accounting, and your government-wide financial statements are including the full accrual basis or the economic resources focus. And so We're going to talk through those in more detail, but really highlighting that the statements are presented in a different way and the information is presented differently. And one is to provide that fiscal accountability to say, how is the organization following their budget? How are they managing current financial resources on your fund level statements? And then on your government-wide statements, how are you managing overall your economic resources focus? How are you managing your resources, looking at the future, and how you'll be able to use those funds for the future? So very different presentation within the financial statements themselves. So now I will pull up the statements again and just highlighting those differences so you can see how it's presented in the statement itself. Now, government-wide statements are always the first statements in your basic financial statements. And what you have here, like I said, you're typically presenting two columns for your primary government. Your focus is on your primary government. So you have your governmental activities and your business type activities, and then you have your total. If you have component units that are required to be presented, which we'll talk through in the next chapter, they will be recorded here as the next column. Your component units, here you have urban renewal, cable television. These are separate component units that are presented, and this represents your primary government. Now, I do want to mention on here, we talked about the different economic focuses, economic resource focus, measurement focus, and the current financial resources focus. Your business type activities here are going to tie to your proprietary funds or your enterprise funds. So let's use an example. So if we were to say cash, so remember this number, you have 3,700,527. And when you go over to your proprietary statements, you're going to have 3,700,527. Your proprietary statements are recorded using the full accrual basis. So when you look at your proprietary funds, you have capital assets that are being recorded. And if you think about these are more similar to a private sector industry, a business. They're collecting money to cover the cost of those items. They typically, unless they are subsidized, they often are earning a quote unquote profit or a net gain in their net position. And so these are recorded on the full accrual basis of accounting. So if you look at total assets here, you have 51,056,637. And when you go to your government-wide statement of net position, you have the amount. Now, the only difference between the two, I do want to mention this, is that interfund activity is eliminated. So when you have internal balances here, they get eliminated. So they're showing you internal of 271, eliminated here, it nets to zero. So that is the only differentiating number between these two columns. Other than that, each individual account is going to tie. So you have capital assets here, not being depreciated, being depreciated. Those are going to be included on your proprietary statements of net position right here. Here's your capital assets that are recorded here in total on this side. The governmental funds are different. So on here, you have your short-term focus, your current financial resources, near-term liquidity, modified accrual. You will hear a lot of terminology that mean the same thing. And so your governmental funds are reported on that basis. So when we look at assets, cash, investments, receivables, more receivables, inventories, prepaid, no fixed assets. Those are not considered current financial resources, so they're not included on your governmental funds. When you get down to your liabilities, you have accounts payable, etc. These are all things that are due within a year, but you don't have your long-term focus. When you go back to your government-wide statements, here's your capital assets being recorded here. And when you look down at your debt, your liability section, you have a lot more numbers on here. AP, contract payable, kind of the same as before, but then you start having long-term liabilities, pension liability, OPEB liability, debt liabilities, bonds, notes, leases, etc., subscriptions that are all being recorded here that are long-term in nature. So your governmental activities here is really showing you, what do I need to spend in the next year? What assets do I have available for me in the current year? Whereas your government-wide statements is, how well is the government doing overall? And how much money do we have available for future economic resources? So really a different measurement focus, a different information that you're providing to individuals and to a user of the financial statements. And both are really relevant. You need both to be able to understand fiscal accountability, to be able to send under operational accountability. Both are important to a user to be able to make decisions about that information. And then, like I said, for the proprietary statements, really just highlighting that that is really the same information. The only thing that is different is that when you do have interfund activity in your proprietary statements, Over here, when you have due from other funds, due to other funds, that gets eliminated on the government wide, and your government wide statements are really representative of the total government as a whole, eliminating all of the interfund activity. Now, turning over to the group before we jump back into the slides, how many of you have worked on governmental funds in your current jobs? And just you can unmute or answer in the chat. Okay. So construction in progress, government-wide special revenue funds. Thank you, Beth. Special revenue funds. Okay. What about proprietary funds? More capital projects. How many of you are working on any proprietary funds going into enterprise soon? Proprietary funds. Okay. Good. So we have people that have working on both enterprise funds, proprietary funds, and on governmental funds. One person mentioned working on the government wide. How many of you are involved with the preparation of the financial statements and do the conversion from the governmental activities level to the government wide fund level? Okay. So one or two people said they do, some said previous positions, concerning fixed assets. Good. Okay. Okay, that's great. And I think that's great that many of you do have the experience already working with this, and really the importance of the differences between these funds is so crucial when you're working on preparing the financial statements. And I will talk through in a little bit the reconciliation between the fund level activity and the government wide activity, because these are things that are unique to government financial statements and are somewhat different depending on which government you work on. Each one has unique transactions, but there are things that are really relevant across all governments. Okay. So our next chapter is going to be the primary government and its component units. And I will share my screen again. Okay. So we've looked at some examples. We've talked through the government-wide financial statements. We've talked through the fund level financial statements. And the primary government, our overall primary government that we're presenting in the statements, that is going to be showing we have our business type funds, the governmental activity funds. There's two columns that we just talked about in the government-wide. But then we have component units. I touched on this briefly when I shared the ACFR, where you can see the two component unit size columns. But how do we define what information gets included in primary government or versus gets included as a component unit? So this chapter really highlights the scopes of the financial reporting entities and the manner of which each separate organizations are incorporated into that one financial statement or the one ACFR report that you're presenting. And let me just ask one more question to the group. How many of you are, I'm going to stop sharing so I can see the comments, but how many of you prepare ACFR reports versus other governmental financial statements? Okay, good. Both. Okay. Okay, great. So we have people that are preparing ACFRs. That's great. Or other statements as well. Okay. So GASB establishes the standards and reporting for the financial reporting entity, which consists of the primary government itself and then the organizations for which that primary government is responsible for or financially accountable for, and then other organizations that the nature and significance of their relationship with the primary government is financial accountability. So they may need to be included in it. So what falls under the category of primary government? What falls into that section that you would have to record within the primary government? So firstly is every general purpose government, state, county, city, town, borough, village, whatever you are defined as, a general purpose government automatically is a primary government. Now, there are some special purpose governments that can qualify as a primary government as well, and there's different qualifications or criteria that they have to meet to be determined to be a primary government. The first is they have to have a separate legal status, so they need to be a legally separate entity or otherwise possess attributes of a legally separate entity. So its own legal name, the ability to sue or be sued, holds property in its own name. So essentially a separate legal entity than another primary government. There needs to be a separately elected governing body. It must be elected by citizens in general election rather than being appointed. So if they have a separate governing body, if they have an elected governing body, they could be considered a primary purpose, a special purpose government. We have to look at the concept of fiscal dependence or fiscal independence. Now, the special purpose government must be free from interference in its financial management. So if that government has to get approval from another government to create its budget, to levy taxes, to define its rates or charges, issue debt, etc., then it would not have fiscal dependence. It would be fiscally dependent on someone else rather than being independent. And that is one of the main categories that you see whether something should be a separate legal entity, a separate primary government, or a component unit within the financial statement. So if a special purpose government does not have a separate legal status, then it is treated as part of the government that exercises the legal powers in its behalf. But if it does have separate legal status, but does not meet one of these other two categories, then it becomes a component unit. So, for example, if you have a government entity that does not have a separate legal status, so for example, a transportation authority, it does not have its own separate legal status, then it is part of the primary government. It will be a fund, it will be within the primary government itself. But if it does have a separate legal status, and then it fails to meet one of these two criteria, then it can become a component unit of that primary government. So it may be its own primary government for financial reporting. It may have to issue its own financial statements as a component unit, but it is dependent on the primary government. So what you have to do is you have to go through an assessment process to say, does this entity belong as part of my financial statements? So the first thing is you would say, okay, it's not a separately legal organization, or it is a separately legal organization, so now it's a potential component unit. Now, is it going to be an actual component unit or not? So the first is financial accountability. And financial accountability is going to be look at whether the primary government is responsible or has financial support of that entity. So you're looking at things like fiscal dependence. Are they fiscally dependent on another government? Who appoints the board? So is the board established on their own, or do they get established by the primary government who's selecting those factors? We're looking at a secondary factor, which is saying, are they providing a benefit for the primary government or a burden to the primary government? Are they supporting that government, or are they required to be supported by that primary government? And do they have the ability to impose will? And so what we're looking at for each of these factors is whether the component unit has financial accountability. And if they do have their own financial accountability, then they are their own separate component unit. And if they don't have financial accountability, we have to determine how they be included in the financial statements. Now, just highlighting again the different types of funds that you would have. Governmental funds, you have the general fund, the special revenue fund, debt service, capital projects, and permanent fund. Proprietary funds, you have the enterprise funds and the internal service. The internal service is a governmental activity on the government-wide. You have fiduciary funds, your pension and OPEB trusts, investment trusts, private purpose trusts, and custodial. Component units can have all of these funds as well if they are their own primary government. So like I started saying before, a government component unit needs to be a legally separate organization, and the elected officials of that primary government are financially accountable for that component unit. So if the component unit has their own independence. They have their own board appointments. They have their own, they're not providing a benefit or burden to the main government, the primary government, then they wouldn't be treated as a component unit. And it might be misleading to exclude them in the financial statements or to include them in the financial statements because of the relationship between the two entities. So in order to determine financial accountability for this component unit, you would say, are the economic resources received or held by the separate organization for the benefit of the primary government, its component units, or its constituents? So if you're answering yes, potentially they could be a component unit. Is the primary government or its component units entitled to or have the ability to access a majority of the resources held by the separate organization? So, for example, if you were to have a community college that is being held by within a local jurisdiction, they may have an arrangement that the community college is being supported by the local county. They may have an arrangement that if there's a surplus of a certain amount, that monies needs to be accessed by the primary government and can be returned to the primary government. These create that dependency between the two organizations that would require it to be included in the financial statements because the organization really would not exist on its own if it was not being supported or being having the officials elected for the board by the primary government. So it's misleading to exclude it from the statements. It's really part of the organization, even if it's a legally separate entity of the organization. And then we ask, are the economic resources received or held by an individual organization that the specific primary government is entitled to or has the ability to otherwise access significant to that primary government? And so if you're answering yes to any of these questions, it becomes a decision of whether this needs to be included in the financial statements as a component unit, as a discretely presented or a blended component unit, which we'll get through. And again, we talked about whether it is a burden to the government, primary government, or it provides benefit to the primary government. And these are all decision-making factors to determine how it should be included in the financial statements. And GASB really touches on that there are component units that are misleading to exclude because even though they're legally separate, if a user were to look at the statements and it wasn't in there, it would mislead them because the primary government is supporting them. They're providing a service that the primary government otherwise would have had to provide, even though they're a separate legally entity. And so it really needs to be included to represent the full picture of that government. So that is why it gets included in its own column. Your primary government is the main government itself, but the component units are the entities that are legally separate, but that are supporting your primary government and are essential to include for you to understand the full purpose or the full picture of that government. Now, how does it get presented within the financial statements? There's two ways that it could be presented. There's blended component units and there's discretely presented component units. Blended component units are presented within the financial statements. They're blended with those of the primary government. They are treated as if they were a fund of the government. Now, the only time that does not get one exception to that is the general fund. We talked about before that you can only have one general fund, but a general fund of a blended component unit needs to be classified as a special revenue fund when they are combined. So a primary government will have one general fund, and then you can have two special revenue funds, and one special revenue fund relates to the general fund of your blended component unit. Now, you can also have discretely presented component units, and those are where the entire activity of that component unit is presented separately from the primary government. So in the example that I showed you before, you have your primary government columns, you have your governmental activities, your business sec type, and your total, and then you have your discretely presented component unit columns. You have your balance sheet essentially, you have your statement of activities that you're including all the profit and loss of those component units. Now, a blended component unit is determined if it has substantively the same governing body and it has a financial benefit or burden relationship. So, for example, you have a component unit that the board or most of the board is the same as your primary government, and they are either providing a benefit to the primary government or they're a burden to the government. So they need to be supported by the primary government. So even though they are legally separate organizations, essentially, that component unit is considered the same as the primary government. The governing body is the same, and they have a relationship between the two. And so, therefore, it gets blended within the financial statements and it functions as part of the primary government for financial reporting purposes. that both of those conditions would need to occur to be presented. The second area is you have substantially the same governing body and you have operational responsibility. So again, same characteristics as the first one. You have the same governing body or mostly the same governing body. And the management of the primary government below governing body, so not the board, manages the activity of the component unit in the same way as it manages its own activities. Therefore, it is blended with the primary government. And so I've seen this sometimes, let's say with colleges and universities that are following GASB standards. You may have a college and then you have a foundation. And the foundation has the same board or substantively the same board. Management operates the component unit of the foundation as the same as its own activities, and therefore it becomes part of the primary government. It doesn't become a separately presented or discretely presented component unit. It's blended within the primary government itself. It also has to provide exclusive or almost exclusive benefit to the primary government. Some component units were created to serve the primary government rather than its citizens. So, for example, if they created a component unit like a financing authority or an administration of employee benefits, a separate legal entity that was designed to support the primary government exclusively or almost exclusively, it can become a blended component unit. So if you have an organization like a housing authority where it was created separately to benefit citizens or residents, that is not falling under this category because it's providing services to external individuals. The next category is that the total debt of the component unit is repayable almost entirely from resources of the primary government. So there is an obligation of the primary government to pay back the debt of the component unit. And essentially, it goes back to that fiscal dependency. The component unit is not really standing alone because they are dependent on the primary government for repayment of debt, and therefore it is considered an integral part of the primary government and blended. And lastly, the sole corporate member. So if the component unit is organized as a not-for-profit organization, but its bylaws or articles of incorporation identify the primary government as the sole member of the corporation, then it is blended with the data of the primary government. And that's a bit unique because legally they are operating or designed as a not-for-profit, but they were designed for the purpose and the sole corporate member is the government. It becomes part of the government for financial reporting purposes. Now, if you have, as you go through this criteria, if you have component units that do not fall into this category, then it is not considered appropriate to blend those within the primary government. And they would need to be presented discretely, which is the second category. So for discrete presentation, so the component unit is not an integral part of the primary government and it needs to be presented separately. And it essentially functions as a primary government in its own way. Then it would have a separate standalone report. It gets reported separately within the financial statements. Now, the data is included in the financial reporting statements as a separate column. You may have one or more columns. You could have an aggregated total column presenting each of those standalone component units as its own entity. Now, these discretely presented component units need to operate with a degree of autonomy. So they have their own autonomy over the organization, but they do have a dependency on the primary government. Oftentimes they get supported in certain ways by the primary government or get a certain allocation of revenue of the primary government. And then we have a certain number of columns that we're required to present for discretely presented units in the government-wide statements. We report all component units in a single column. That's one option. Or we can report separate columns for each major component unit with a single column for all non-major component units combined. And then you would present those in the financial statements as a supplementary information where you would present the details for those statements. Or you could have separate columns for each of the component units. And you see that a lot where each one has its own column and it's representative of that standalone activity. Now, when a component unit is major for the financial statements, you have to make sure that it is based on size. You're going to include in the financial statements. The financial statement users need that separate information because of the type of services that it provides for the citizens. The component unit is engaged in significant transactions with the primary government, and there's a significant financial benefit or burden relationship with the primary government. And so when you have discretely presented component units, like I said, you present them in the different columns depending on how you elect. You need to follow all rules that are applicable to the primary government. All the GASB pronouncements that we talked about all need to apply to that component unit as well. And then the relationship to that component unit should be to the primary government, should be disclosed on the cover of the report and in the footnotes to the statements, where you're disclosing to a user the relationship between the primary government, the component unit, and how the information is presented and combined within the financial statements. Now, we're going to take another 10-minute break before we jump into chapter 7. So we'll stop the recording and we'll come back, let's say at 11:25, we'll come back to continue on with chapter 7, which is the measurement focus and basis of accounting. Okay. So like I said, jumping back into chapter 7, the measurement focus and basis of accounting. Now, the concepts that we're talking through in this chapter, we've already touched on in earlier conversations, but this is really pulling it all together and going over the requirements and the rules around the measurement focuses and the basis of accounting. Measurement focus is the type of transactions and the events that are going to be recorded in the financial statements. And it helps you determine whether you should or should not record it. And it tells the user of the statements for a government fund what are the transactions or events that have increased or decreased the net resources available for spending in the near future. So the current focus, the current financial resources, or what we call modified accrual financial statements. So if you think about it, only certain assets and liabilities will affect your near-term liquidity. So for example, if you have cash in the bank, you can use that to pay for future payables, for future purchases, to be able to spend that money. But if you purchase a car, the car, once you've spent the cash, the car can't help you with future resources. And similarly, if you're going to have a mortgage payment that's due tomorrow, it's going to be spent using current resources. But if you have a payment that's owed in 10 years from now, you're not really going to be using current money to spend that, but you'll need future money to be able to spend on that. So using the current financial resources focuses, we're focusing on the current information, the modified accrual, the near-term liquidity. For a proprietary fund, we're saying what transactions and events have increased or decreased the total economic resources during the period. So you're using the full accrual basis and talking about what happened during the current year, but then leaving in the assets and liabilities for the future year. So we had talked about the different fund statements that we're preparing: governmental statements, proprietary statements, and fiduciary. Proprietary and fiduciary fund statements are going to use the economic resources associated with the operations in those funds. They're going to be using the full measurement focus or the full accrual basis. Governmental fund activities are going to be prepared using the current financial resources measurement focus. So you have the economic resources measurement, current financial resources. Touching back on what we talked about before in earlier chapters, when you're talking about fiscal accountability and operational accountability, fiscal accountability focusing on the current budget, focusing on the current cycle, budgetary cycle of a year, current financial resources measurement focus. Proprietary fund and fiduciary fund statements are using economic resources measurement focus. That's the full accrual basis. And so what you're looking at in both of these cases, you're reporting the same type of elements in the financial statements. You have the 7 elements that we talked about before: assets, liabilities, inflows and outflows, etc. But your focus of when you should record them is going to be different. Now, the basis of accounting, like I said, it's tied to the measurement focus of that fund itself. If it's going to be the basis of accounting, to differentiate between the measurement focus and basis of accounting, will be how you will be presenting the statements. So you've determined what your focus will be and how you measure those transactions, and then you determine how you're going to account for them. And so for current financial resources, governmental activities, you're going to be using the modified accrual basis. And that's defined as that your revenue is recognized when it's measurable and available, and liabilities are recognized as expenditures when they are due. The focus on the total economic resources, or using the economic resources measurement focus, that uses the accrual basis of accounting. And revenue is recognized when earned, regardless of the timing of the cash flow. And expenses are recognized as soon as the liability is incurred, regardless of the timing of the cash flow. So if you think about this, the accrual basis of accounting for governments is really not very different than accrual basis of accounting for any other entity. not-for-profit, corporate, public company, etc. The revenue recognition principle is that you're recognizing when you've earned that revenue. So if you've earned the activity within that revenue, you record the revenue, you return the cash, the receivable, whichever type of a transaction it is, regardless of when you're going to be receiving the cash flow. Now, under the modified accrual basis, it doesn't say when earned. It says when measurable and available. So it has to be both measurable to the entity and it has to be available. So there is a focus on the timing of when you will actually receive that money to be able to consider it to be revenue to the government. For liabilities, on a full accrual basis, your expenses are recognized as soon as the liability is incurred, similar to other entities, regardless of the timing of the cash flow. Once you've incurred that liability, you record the liability, you hold that payable. It could be years that you have to pay out that money, but you have incurred that liability, so you're now responsible for that liability. On the current financial resources, the modified accrual, the liabilities are recognized as the expenditures when they become due. So the timing of when you're going to pay that money is important. So if you have a multi-year contract and in year one you owe a certain amount, that is current. But year two, three, four, five, six, those are long-term in nature and they're not using your current resources to pay for that. So the cash that you have today isn't going to pay for the payments in 10 years. That's going to be different cash that came in through different revenue. And so you're really focusing on that current year rather than the future year. Now, within the financial statements themselves, and I'm going to pull up the statements in a moment, but the way they are presented, the names of the statements are going to differ because of these differences. So, highlighting that the economic resources, the full accrual, includes all assets, all liabilities of the organization. For the current financial resources measurement focus, you only record financial assets and liabilities that are expected to be paid with current resources. So we talked about some of these before, but the issuance of long-term debt is not recorded in the current basis because you will not be using current resources to pay for it. The repayment of principal of long-term debt following that same concept. The capital outlays. So if you're using on a current basis, you report capital outlays, but you don't report capital assets on a current basis because they are future items and they're not using current resources. You don't record depreciation and amortization because you're not recording the assets themselves, you're not recording the expense. So from a financial statement perspective, if you spent $10,000 on purchasing a piece of furniture, from a current financial resources, that becomes a capital outlay or an expense in the year it's spent. You use current resources to purchase that item, therefore it's a cash outflow and it becomes a current year expense. Under full accrual basis, economic resources focus, measurement focus, it becomes an asset. Depending on what your threshold is, of course, but if you were going to record it, you record the capital asset, and then each year you depreciate that and record the expense over the useful life of that asset. So the focus is really different, and the information that's included in the financial statements is different because of that. So I'm going to share my screen right now with the ACFR. And I really want to highlight some of the differences between these statements. So starting with the government-wide, which is recorded using the economic resources measurement focus, you have your statement of net position. This is your full net position. It's the economic resources measurement focus, it's full accrual accounting, and it records all assets, all liabilities. So like I had mentioned before, your capital assets being depreciated, not being depreciated are included on here. When you get to your long-term liabilities, you're going to have items that are due within 1 year, pension liability, OPEB liability, bonds, notes, leases, subscriptions, claims, compensated absences. You have a bond anticipation note payable. You have a lot of different items. You might even have more AP and other accrued liabilities that are not recorded. Compensated absences, example, that are not recorded on the current financial resources. And here, when you look at this page, you have your net position. You're getting to a net position basis that you're reporting the full measurement focus for that government, that state and local government. Now, the statement of, I will rotate this so you can see it. Your statement of activities is essentially your profit and loss for your government-wide, but again, it's focusing on that full government-wide, full accrual basis. And if you remember on the slides, what we had talked about is like revenue, like full accrual basis, your revenue is measured when earned. So when you're looking at your charges for services, grants, operating grants and contributions, capital grants for the primary government on top, the component units on bottom, and you break it out between the governmental activities and the business type activities, this is presented showing full accrual basis for your revenue, measured when earned, and expenditures or expenses really are recognized when they have been incurred. And so that you're recording it here. So down here, you have your general revenues that are outside of these three required categories above for the primary government, and you have your total net position at end of year. Now, the balance sheet, and if you notice this, the names are different. So you have your statement of net position and you have your balance sheet. Using the modified accrual, you're presented to show a balance sheet. And that's really showing your current financial resources measurement focus. And it's showing the balances as of this year end. And you're showing fund balances. So rather than showing net position overall for the government, you're showing the balances of each fund. And then there's different categories of how you're breaking it down, but you would have your different funds that we talked about before, the different governmental funds. Your assets would only include current financial resources assets, and your liability would only include items that are expended in using current financial resources. So if you look here, your AP is 4.3 million, 4.4 million. If you look up here in your liabilities, your AP is 8.1 million. Now, in your governmental activities here, it does include the internal service funds, so it typically would not tie directly to this column, but there's big differences because this is really representing only accounts payable that are expected to be paid within a current period of time. And it doesn't include the long-term liabilities. So when you look at the other liability sections, you do have some bond anticipation notes payable. In this case, they are expected to be spent within a current year, so they're recorded on here. But the rest of your payables are smaller. They really represent items that are going to be paid within the future year. And then on the proprietary fund statements, well, this is still governmental. On the governmental funds, you have your statement of revenue, expenditures, and changes in fund balance. And this is really a statement of resource flow. It's showing what came in and what came out using the current financial resources. So again, the name is different. Statement of revenues, expenditures, and changes in fund balance compared to statement of activities. So you have a difference in how you're presenting it. And what you're showing on here, I think I went too far. Here we go. You have your revenues, you have your expenditures broken down by category, and these are revenues that are measured when they are both measurable and available. So within a certain period of time, that cash flow has to be available. If it's not available, you end up with what we call a deferred inflow of resources, an unavailable revenue. So here you have unavailable revenue property taxes, unavailable revenue special assessments, unavailable revenue grants. These become almost like a liability position. They have credit balances and are reported in the statements as unavailable revenue to the organization because they're not available to meet the requirements to be reported as revenue here. So they're measurable, you can calculate the amount, but they're not available to the organization. And then you have your expenditures that are being recorded as they become due rather than when they are incurred. So again, that timing item that you're focusing on. And then you have your fund balances similar to how you present before. And then highlighting that your proprietary funds look exactly like your government-wide because they are using the economic resources measurement focus, the full accrual basis, and they're presenting that information really the same way you'd present it on the government-wide. So again, you have your non-current assets, your capital assets that are being shown here. And then on your statement of revenue, you would similarly have depreciation. You'd be picking up that depreciation expense in the current year rather than not using the modified accrual. You would have your long-term debt and your liabilities. You'd have your long-term liabilities that are being recorded, debt, compensated absences, net pension liability, OPEB, etc. These are items that would be recorded in your proprietary statements and in your government-wide statements. And then, of course, I had mentioned earlier the fiduciary funds do as well, but they on a full accrual, but they don't have as much activity. And what I wanted to highlight on here are the reconciliations. So there are differences in the accounting, the basis of accounting, differences in the measurement focus between the full accrual and the modified accrual. So how do you reconcile between the two? So the financial statements are required to record a reconciliation of the balance sheet of governmental funds to the statement of net position and about a reconciliation of the statement of revenues, expenditures, and changes in fund balance of governmental funds to the statement of activities. So essentially, it's reconciling between the two statements so that a user can see what are the differences in the measurement focus and the basis of accounting between the two. So if we start off with the balance sheet, you're starting off with your fund balances in your governmental funds. So I will jump around so you can see the numbers, but you have 27 million here. If you're going to go up to your balance sheet, you have 27 million here. So that is your total fund balance for your total governmental funds over here. And that will include all your fund types, general, special revenue, capital projects, debt service, and a non-major if you have. You're starting off with your fund balance. Then you need to add back in your capital assets, net of accumulated depreciation. So these numbers here will tie back to your footnotes. It's your capital assets at cost, your depreciation, and then you have your total governmental activities, capital assets that are recorded and being picked up. So where that will show on your statements, and now these are, you have to add in these two lines, but you would have capital assets not being depreciated here, net capital assets, net of accumulated depreciation here. That is going to tie back to your reconciling item of 285 million here. Then you have differences between expected and actual earnings or experiences, assumption changes, projected and actual earnings. And these are all the deferred inflows and outflows that are related to pension. So if you think about it, on your current financial resources, over here, you don't include pension. In your deferred inflows and outflows, you don't include anything related to pension or OPEB. So those items are going to show up as differences between the balance sheet and the statement of net position. So here you're picking up your deferred outflows, your deferred inflows, and for each of these pension OPEB to pull them into your net position balance. So you can see this on your statement of net position. Here you have your pension related deferred outflows. So it's 8176, OPEB related about 2 million. Now there are some timing differences because this does not include the internal service funds. But if you were to take the number that's on your financial statements and back out the internal service funds, you would end up with the number on here. Then you have some receivables that will not be available to pay for current period expenditures and are offset by unavailable revenues in the governmental fund. So what I had talked about before is that on the current financial resources, revenue is earned when it's measurable and available. So if you have tax types that are considered unavailable for governmental funds, they could be revenue on the government-wide funds. And therefore, they're going to be recorded as a deferred inflow of resources on the governmental funds and revenue on the government-wide. So but they become a reconciling item between the two. Now, in this case, this was another capital asset. You have your internal service fund activity because on your governmental statements, your internal service fund is not included. It's a proprietary statement. Excuse me. And then you have your long-term liabilities that are not due and payable in the current period and that are not reported in the fund level accounting. Bonds payable, notes, more bonds payable, compensated absences, pension, leases. This is actually pension-related debt, subscriptions or SBITAs, accrued interest payable and long-term debt, OPEB liability, pension liability. So you have a pretty large liability here that's being picked up. And then you have some premiums and discounts related to debt that were not recorded on your fund level. And then you end up with your net position of governmental activities, which you'll see over here, the 144,801, 791 on your statement of activities, 144,801 on your statement of net position. Any questions on the differences between these schedules and on the reconciliation? I'll stop sharing for a minute because I can't see the chat when I share. so no questions. How many of you have prepared the reconciliation schedule before? Okay. We have a few that have. How many of you have not prepared it? Okay. And we have a few that have not. So I like using this schedule when we're going through these slides because I do think it shows the story between the two schedules, the two statements. It tells you the story of the reconciling items, and it really highlights those components that are different between the two measurement focuses and the two bases of accounting. And until you start working through those schedules, it's hard to really piece together those various components. But then you can see that that it's easier to reconcile between the two because there's really those four broad categories that say, okay, this gets included in one measurement focus, this doesn't get included in the other, and how do I reconcile between the two? And so I'm going to just walk through the second reconciliation, which is the reconciliation of the statement of revenue and expenditures, as well, highlighting those differences in the current and economic resources measurement focus, and then in the basis of accounting. So similarly, you start off with your net change in fund balance. You're starting off on the governmental funds. Here is 14 million. Down here, you're 14 million. And now you're picking up the cost that the governmental funds report capital outlays as expenditures. In the statement of activities, you're reporting the capital assets and recording the depreciation. So your depreciation here is going to be picked up on your statement of activities. Now it'll be recorded it's buried in these expenses numbers, but that is where your depreciation is going to be picked up. Now on your government level, on your current financial resources, you're reporting here a capital outlay, a disbursement of funds, of current funds. Your next category is revenue that do not provide current financial resources that are not reported as revenue. So these are items that are earned but unavailable grants, property taxes. So under the full economic resources, back in the slides, we talked about your recording revenue when it's earned. But current is when it's measurable and available. Full economic resources is when it's earned. Then we have some other various transactions that are being recorded, your bonds and other debt proceeds that use current financial resources for governmental funds, but debt for long-term liabilities for the current statement of net position, and you're picking up all that activity. You're also going to pick up your internal service funds that are recorded here, and then any expenses that do not require the use of current financial resources are expenditures in the governmental funds, or not expenditures. And then you end up with your change in net position in governmental activities, 12 million, which you're going to pick up here, your 12 million right here, 12.5. So there are quite a few differences between these statements, both in the information that you're sharing, and so that reconciliation helps you put together those pieces to really tell the story of what changed between the two and what the differences are between those two different measurement focuses. Now, I do want to highlight on here that oftentimes the transactions, we talked about accounting and we talked about financial reporting. These differences often apply to the accounting. I'll share my screen again. So when we're looking at it, we're talking about transactions or events that have occurred. So we're looking at the accounting itself, and when the transaction occurs, how do we report it? On the fund level accounting, you're typically reporting your current financial resources. So your transactions that you're reporting are on the current level. But then for financial reporting purposes, you have to convert to that full economic resources. And a lot of times that's done through gap journal entries, where year end you're recording the accounting for the capital assets for the debt, or you may be doing it throughout. You have to be able to convert between the two. And so really highlighting that when you are assigned to work on a fund, depending on the fund that you are assigned to, you want to make sure that you understand the basis of that accounting and which type of fund that you're going to be using or kind of measurement focus you're going to be using. If you're assigned to a governmental fund, capital projects, debt service, a lot of people said they worked on those areas. You're using that modified accrual basis. You're recognizing liabilities as expenditures are due. You're recognizing revenue as they're measurable and available. And I do want to highlight that in the footnotes of the statement, it'll tell you what available is. So it might be 60 days, 30 days, depending on the what the entity has elected, but it'll tell you what's considered available to the organization. If you're working on a proprietary fund or on government-wide statements, you're using that total economic resources or the accrual basis of accounting, where you're recognizing that revenue when it's earned, regardless of the timing of the cash flow, and the expenditures or expenses as soon as that liability is incurred, regardless of the timing of the cash flow. So the focus is a little bit different, and it does require that mindset shift to be able to say which type of fund am I working on and which type of basis of accounting or measurement focus should I have in mind. I'm going to stop for a moment to see if anyone has questions. Okay. So for those of you who have worked on government-wide statements or the reconciliations, have you ever had challenges with reconciling the one statement to the other, the full accrual to the modified accrual? And can you share that? Anybody? Okay. So for those of you who do not work on the reconciliations, have you had questions related to this that have come up in the line of work you do? Okay. So you have questions that come up in the audit. Sarah, could you elaborate a little bit at what type of questions come up? Okay. So what Sarah was saying is, where the figures come from and making sure the math lines up because the transactions, these statements need to reconcile between the two and figuring out which transactions are reconciling items and how to properly get to that reconciling statement that we had talked about before. And I think that's a common one is just being able to pull that information and identify which portion of it um, should be reconciled out. So I'm going to pull the statements back up again and just highlighting that. So when we had talked about, I had mentioned the accounts payable. So when we're looking at the government-wide statements, we have accounts payable and other accrued liabilities here of 8.1 million. And then on our fund level statements, we have 4.376. On our proprietary statements, we have internal service funds that have to be backed out of 824,000. So you have a big chunk of liabilities of accounts payable that is a reconciling item. And it becomes an exercise to say, how does that properly get backed out on here? Does it fall in the correct category? Is it being recorded correctly? And should it be a reconciling item? And you do want to make sure that you're picking up things and recording them in the right section on the financial statements to make sure that it gets correctly pulled out or added in as a reconciling item on the statements itself. And I do want to highlight on here, like we had talked about, when you're doing this reconciliation, it's the total governmental funds. So some of the major differences we talked about, the debt service costs, principal, interest, and issuance costs are often flowing through debt service, but they could also float through capital projects and issuance costs through general fund. So you could have multiple components or multiple funds that are feeding into that reconciling number. Your capital projects fund is usually where you're picking up all the capital outlay here, but sometimes you may have capital outlay that's included in the general fund. So I'd mentioned earlier that when you have smaller costs that are not related to major acquisitions or major projects, those capital outlays can be recorded in here. And so for those of you who have been recording these government-wide statements, those of you who have done these reconciliations, it becomes an exercise to identify what is related to capital outlay that's included in here and needs to be reconciled out on the financial statements. Now, on these statements here, your capital outlay number is going to tie back to what's in your capital outlay in the statements, both in the capital projects funds and in the general fund or other special revenue fund if you have any. And it's also going to tie to your financial statement footnote. And so this is where you end up with these reconciling questions is in your footnote down here, you have your capital asset activity for the year, which shows you all your additions, which in this case would be your additions here, capital assets not depreciated, and this addition here, less the transfers from CIP to additions here. And the total of that needs to equal 15 million, which is what you're reporting on the reconciliation up here. As right here as capital outlays, 15,132, that needs to tie back to your footnote. And that is not necessarily just going to be your capital outlays that are showing on your statement over here. It's not necessarily just these. Just something to keep in mind as you're moving through these reconciliation and understanding some of the differences between the two fund types. Okay. And then I'm going to open up again, see if anyone has any more questions. We're finishing up a little bit earlier than the time that we had allotted. We had not a lot of questions today. And then in the afternoon, we'll be picking back up with chapter 8. Chris Lehman will be joining to teach that part of the chapter and moving into the categories of transactions and events. But does anyone have any questions on chapters 1 through 7? Okay. Well, I appreciate everyone joining me this morning. And please join back. And Brianna, can you correct me on this? I know we were supposed to start at 1. Do you want to start a little bit earlier or just keep that 1 o'clock start time?
One is fine. Yeah.
Okay. So we'll be starting again at 1 p.m., continuing on with chapter 8. And thank you everyone for your time this morning.
Thank you, Toby.
All right, thank you, Brianna. So I'm Chris Lehman. I'm with SB and Company. I'll be taking us through this afternoon's session. We'll be going through chapters 8 through 14, which these chapters will build upon what we went over, or what Toby went over this morning, talking about the governmental fund financial statements. And I know this morning was built upon more about talking about the fund financial statements, the entity-wide, talking about the structure, the measurement focus and basis of accounting for governmental funds. So what we'll talk about mostly this afternoon is really talking transactionally and talking about the different types of categories and types of transactions, from a revenue perspective, from an expenditure perspective, um, as well as assets, liabilities, and really all the line items that we're going to see within the financial statements. Talk about how those are recognized and reported within the financial statements. The last chapter, 14, will talk about a little bit of reporting for the proprietary fund or enterprise funds, but the majority of our conversation will still be around governmental fund financial statements. I know Toby also shared the Gaffer financial statements, if you will, which is a sample set of financial statements that the GFOA has published and is available on their website. So I'll continue to use that, make some references to the illustrative act for, where appropriate. So we can just kind of build upon what we go through this afternoon and link that to the sample act for here as best that we can. So I'll be using this in combination with the slides, as well as those of you that have the blue book. If you've got that, I'll just make references to where we're at within the blue book as well. So we are scheduled to go to 5 p.m. We probably will end a little early this afternoon, but we will cover all the materials that we need to. I will build in a couple breaks just to give us a little bit of a coffee break here in the afternoon. So I'll build in a couple breaks just to re-energize. And I guess Brianna, do you have any other housekeeping items, or am I good to go?
Nope. Just remember to take the polls when they pop up, and that's about it. Just you, Chris, don't say anything about the polls.
Okay,
It's
I'll try not to.
pretend like you don't
Sometimes
see
old
them.
habits die hard, but I'll try not. I'll
No, no,
try
you're
not to
completely
say,
fine.
"Hey guys, wake up! Press that I'm here." But
Yes.
no, if you guys have questions, I may pause every now and then to see if there's any questions. You could definitely use the chat feature. I'll try to keep an eye on it so that way I don't get too off base if there is a question, but feel free to use the chat. And then I just realized I do need to share my screen before I start with the slides, so just bear with me here. All right. Let's see. Oops, hold on. Bear with me. Can you guys, Brianna, is my screen sharing work?
Yes, I can see it.
All right, hold on. I'm trying to. Okay, you can see it. All right, perfect.
Yes.
So starting with chapter 8, now we're going to get into types of transactions, and we're going to get into how those items are recognized. So really, this is most of this chapter is going to result in talking about revenue recognition. And keep in mind, this is governmental fund financial statements. So just broadly, we have governmental fund financial statements. That's your general fund. That's all the different types of governmental funds, whether that's a debt service fund, capital project fund, special revenue. Now, this accounting is going to be different here for governmental funds than it's going to be for proprietary, as well as keep in mind that the entity-wide financial statements does have some variations to it as well. So keep in mind, this is still governmental fund focus here. So in chapter 8 of the Blue Book, it's introducing us to three broad categories of classes of transactions. So there's exchange transactions, exchange-like, and non-exchange transactions. The idea here is that governments enter into all sorts of revenue generating transactions, and depending on the nature of the transaction is going to drive the revenue recognition. So if you think in a quote unquote normal business, a customer would buy a product from the business, and whatever that amount of cash is paid for the product or the service, that's considered an exchange transaction. That's basically equal value is being exchanged. The customer gets the product, the business gets the cash, they get the revenue. That's considered an exchange transaction. But not all transactions that governments enter into are exchange transactions. There's lots of different types of transactions, and depending on those categories, that's going to drive revenue recognition. So an exchange transaction is when there's equal value exchange between the customer and the business. Exchange-like transaction is very similar to an exchange transaction, and that's where the government may be providing, a little bit more than just it being a straight up exchange transaction where it's equal value. Maybe the government is subsidizing services, so it's not quite that customer may not be paying 100% of the value of that service or for that product, but they're paying fairly close to it, right? So that's considered an exchange-like transaction. And then non-exchange transaction is where there's not equal value exchange for the service or for the product compared to what that customer is paying for. So governments, generally speaking, enter into all three types of arrangements. Sometimes the non-exchange transactions can be a very material part of a government's set of financial statements, even more so than the exchange transaction. Now, keep in mind, so and I mentioned exchange transactions where there's equal value being exchanged, which you may see that more in proprietary fund accounting because, a business type fund or a business type activity, the nature of that is providing a service to customers. But that's not to say a governmental fund cannot have exchange transactions reported within the governmental funds. A general fund can have charges for service revenue, and there's not a requirement for charges for service revenue to be in a proprietary fund versus a governmental. So just keep that in mind. Governmental funds can generate revenue through services if that service is not already captured within a separate proprietary fund. So, and then the non-exchange, well, as I mentioned before, so the exchange transactions is where there, and if you have the book, this will be in section 8-1 where it defines each one of these three types of transactions. So the exchange transaction is where uh, there's a transaction between businesses or between individuals, and each party to the transaction gives and receives equal value. Then the exchange-like transaction is where parties to an exchange may be willing to give and receive value that is similar, but not quite equal. A seller, for instance, may be willing to accept a lower price from a related party. Likewise, a portion of the value involved in an exchange could be diverted to the benefit of a third party. And then thirdly, so accounting and financial reporting as far as how we're going to group the transactions and talk about differences in revenue recognition and accounting, the accounting for exchange and exchange-like transactions is the same. So if a transaction is based on equal value versus a transaction being close to equal value, they're going to be recognized the same way from a revenue recognition perspective. Thirdly, when we talk about the non-exchange transaction, that's where we're talking about specific types of whether they're derived tax, there could be derived revenues, there could be imposed type revenues, there could be government mandated type transactions. So this is where think about, sales tax. That would be an example of a derived tax revenue because a derived tax revenue is based on an underlying transaction taking place that then the government is charging a tax related to that transaction. So for an example, sales tax revenue it's derived upon a sale between a business and a consumer or a customer, which is then generating the sales tax revenue. Therefore, that sales tax is derived from that underlying event. So GASB, or the Blue Book here, defines what certain types of revenues qualify as non-exchange revenues, and then there's going to be certain revenue recognition criteria to follow related to that. So most of this chapter is going to highlight what are those examples of non-exchange uh, revenues. Now, so exchange and exchange-like transactions, as I mentioned, very similar in the reporting. So once a transaction takes place, or once that exchange takes place, a government's going to recognize a receivable and a revenue. So as soon as that sale takes place, the exchange takes place, the government's entitled to revenue at that point in time. And once that transaction takes place, a government would have a receivable for any amounts to be received for that and the associated revenue. If the sale takes place and the cash exchanges hands, simultaneously, of course, that would be cash coming in or a debit to cash, and you have a credit to revenue. But if there's a lag between when the transaction takes place and the actual cash being collected, that government would be entitled to a receivable. So your debit would be to accounts receivable, and the credit would be to revenue. So now let's get a little bit into, let me take a look here. All right, just a couple slides for this chapter. So getting into the types of non-exchange revenues that there are. And the idea here is that, governments operate very differently from private businesses, which is a big reason why there's governmental fund reporting versus what we see in the proprietary fund or the business side of things. And one of the main drivers of governments is to provide services rather than generating a profit or generating sales. So when a government is providing those services, there's types of transactions that they enter into that they're not always receiving revenue from sales that are driving the services that they're providing. And that's where we're getting into these different categories of revenue. So an example, first, if we get into derived tax revenue. So governments frequently generate revenue from exchange transactions. And again, the derivative here, the derived from, would be that underlying exchange transactions. So the governments frequently generate revenue from transactions to which they are not a party. So they are not the seller or the consumer related to the exchange transaction. And in that situation where a government, if they impose taxes on certain types of exchange transactions that take place within their jurisdiction, that's where they could be the recipient of a derived tax revenue. So the book here in section 8-2 mentions an example of a county may impose, and here we know in Maryland that's going to be at the state level, may impose a sales tax on a transaction between a merchant and their customers, or it also says a state may impose an income tax on compensation paid by employers to employees. So sales tax is derived from an exchange transaction between, a merchant and a customer. Income tax is derived tax revenue between an employer providing compensation or earnings to its employees. So those are just two common examples of derived tax revenues because the revenue results or derives from events unrelated to the government's own operations. So the government's not involved in operating, sales or providing compensation to the employees for the income taxes. So in this situation, when there is derived tax revenue, a government should recognize both a receivable and a revenue. as soon as the underlying exchange transaction is taking place. So similarly to an exchange transaction, where once the transaction or the sale takes place, a government's entitled to its receivable and its revenue. Derived tax revenue is not too different. In fact, but the only difference that underlying transaction didn't happen at the government level, it happened outside the government's operations. But once that underlying transaction was taking place, a government is entitled to its receivable and its revenue at that point in time. So the point in time is not different between an exchange transaction and a derived tax revenue transaction. So when that receivable and that revenue is recorded, just keep in mind that receivables are required to be recorded at their net realizable value. So if there's any refunds or uncollectible amounts or bad debt, if you will, that's expected to result in any derived tax revenue situation, that receivable should also be analyzed to say, do we believe we're going to collect the full, the 100% of this underlying transaction, or do we need to put some sort of allowance on it? But keep in mind, once the transaction takes place, that's also the appropriate time to determine its net realizable value and recording that as such. So it may not, the revenue and the receivable may not be at 100% of the underlying transaction of what's entitled to the government. Now, if a payment is received prior to the exchange, which I know prepayments aren't super common with governments, probably especially with derived tax revenue. I don't know how often I see prepayments of a derived tax revenue, but if there was a payment received in advance of the underlying exchange, then there'd be a corresponding liability of unearned revenue. So I guess theoretically there could be cash collected in advance, so you debit the cash, and then there would be a credit to unearned revenue. And then once that underlying transaction has taken place, that unearned revenue would then be recognized as revenue. So there is an exhibit here in the blue book, and it's referenced here in the slides, but Exhibit 8-1 basically just summarizes what we talked about between the sales tax and the income tax example. So it just shows in a little chart format of when is the account receivable recognized for sales tax. It's when the sales take place. And when is revenue recognized from revenue recognition perspective? When the sale takes place. From an income tax perspective, when is that receivable and that revenue recognized? When the income is earned. This was introduced in a previous chapter when Toby covered it this morning, but keep in mind there is an availability factor, and we'll talk about that a bit too this afternoon, is that in governmental fund financial statements, receivables and revenue not only have to be earned, but they also have to be available. So that there's a time period element here that we need to consider about the collectability of accounts receivable. And that's a big theme of governmental fund financial statements, because governmental fund financial statements are on the modified accrual basis of accounting. So it's not full accrual, meaning full accrual if you think in a normal or if in a business type financial statements or proprietary fund financial statements. Once revenue is earned, you've got the receivable, you've got the revenue, you have that positive impact to net position because of that revenue. And it doesn't matter when the receivable is collected. As long as it's determined to be collectible, that revenue and that receivable, stays within revenue recognition. But in the governmental funds, there's an extra element of availability that plays a part in revenue recognition. So right now, for derived tax revenue, when we mention the underlying transaction taking place of when that receivable can be booked and when that revenue can be recognized, keep in mind that there's still a availability component to that, and that'll be that was a theme this morning, and that'll continue to be a theme this afternoon. So if you guys have questions as I go through this, please jump in. Let me see if I can see the chat. Oops. Can you guys still see me and hear me? Brianna, am I good?
Yeah, you're good.
Okay, good. I just had something pop on the screen that made me doubt that. I don't know if I can see the chat. Hold on. I'm trying to make sure I can monitor the chat. Okay, good. I can see the chat now. All right. Hopefully everyone can still see the screen. So yep, I'm still on the slide for non-exchange transactions. So the derived tax revenues again are the sales tax and income tax I mean, there could be other examples. Those are largely common examples of derived tax revenues. So the second example we have here is imposed non-exchange revenues. The short example of this would be property taxes is a common example or an example of an imposed non-exchange tax revenue. So for a property tax, that's assessed typically on an annual basis and doesn't result in an underlying transaction needing to take place in order to trigger that property tax. That's just imposed on an annual basis, irregardless of any sort of transaction. So the next example we'll talk about is imposed non-exchange revenues. So the book defines imposed non-exchange revenues, says it describes all assessments that a government makes and does not involve exchange transactions. So these are assessments. So an example they have here is an assessment could be ad valorem taxes is the term, the technical term of property taxes. But if you see the term ad valorem, that's property taxes. So property taxes are an example of what we're discussing here. Fines and penalties. So a fine is imposed. It's not based on any sort of underlying exchange. And then another example here is property forfeitures. So property taxes, fines and penalties, forfeitures are just three examples that the book gives of imposed non-exchange revenues or transactions. And a government should recognize a receivable in connection with an imposed non-exchange revenue as soon as they obtain and this is the key here, an enforceable legal claim to the resources. So what's triggering revenue recognition, again, here for imposed non-exchange revenues is an enforceable legal claim. So whereas derived tax revenue was an underlying transaction taking place, imposed non-exchange has to do with an enforceable legal claim to those resources. And then revenue should be recognized at the same time. That's okay. So the government should recognize a receivable once there's an enforceable legal claim and should recognize revenue at the same time, unless there is a time requirement that doesn't match that receivable element. So unless there is a time requirement, in which case the revenue cannot be recognized until the date that spending can begin. And if payment is received or a receivable is recognized earlier, a deferred inflow of resources must be reported. So there could be a time difference in when there's an enforceable legal claim to the revenue compared to when the spending of that revenue can be. If there is a timing difference, then there could be a receivable that's recorded, but then there could be a deferred or unearned revenue because that spending cannot happen yet. I don't see that very often where there's a gap in time period between the claim to the receivable and the spending of it. So I'm not sure really how common that is, but generally speaking, once a lot of times see the enforceable legal claim happening also at the same time that the spending can occur of those funds. But just keep in mind there could be a time difference between receivable recognition and revenue recognition. Receivable recognition being that enforceable legal claim. Revenue recognition is once that spending, you have that enforceable legal claim and spending can begin. So sometimes governments, I think they're elaborating a little bit here on what I just said, but sometimes governments obtain a legally enforceable claim to property taxes only after the period that those taxes are intended to finance. In that single instance, a receivable and revenue should be recognized at the start of the period that they are intended to finance. So if you've got the book, they've got a little chart also in Exhibit 8-2 that highlights an example of receivable recognition and revenue recognition for property tax, as well as for fines and penalties. So again, we talked about the property tax, but that outlines there the receivable time period and the revenue recognition period. So for fines and penalties, when is the receivable able to be recognized? Fines and penalties, when acknowledged by the individual or imposed by court, is driving fines and penalties, receivable and revenue recognition. So again, for fines and penalties, receivable and revenue recognition, when acknowledged by the individual or imposed by court. Getting into the third category here, we have government mandated non-exchange transactions. In a shorter term, we can call these grants. Now, depending on the type of grant, there's different categories of grants. But generally speaking, let's think of grants as these government mandated non-exchange transactions. So the book talks about here is one level of government. Sometimes what happens is one level of government, in this case, the state, will mandate that another level of government, i.e., a school district, perform a service while offering at least partial funding. Uh, Accountants describe such as funded mandates. So a funded mandate is also an example of a government mandated non-exchange transactions. So government should recognize a receivable in connection with government mandated non-exchange transactions when, as soon as they meet all applicable eligibility requirements. So one of the key elements for grant recognition here, or if you call this the fund, this example, the funded mandate, eligibility plays a factor into revenue recognition. So with this funded mandate, the receivable is recorded upon meeting eligibility requirements. Government mandated non-exchange transactions are presumed to incorporate a time requirement if the agreement or the grant agreement or the contract fails to specify the relevant period. It is presumed to be the fiscal year that the government provides the assistance. If assistance passes through some middle layer of government, or for example, a county, the relevant period is the fiscal year of the provider of the county in this example. So revenue is recognized at the same time a receivable is booked. So once spending can occur on those items, and it meets the time criteria of the grant agreement, and it meets eligibility. So it's got to meet the eligibility criteria and allow for that time period has been triggered for spending. That's when the receivable and the revenue will be recognized for a formula grant. Probably more commonly is what I see is expenditure driven grants or reimbursement grants. And that's where a government receives a grant. That could be, if we're talking about a county government or a local government, that could be a state grant, that could be a federal grant. But the the spending of the grant is what's triggering the revenue recognition here. So a recipient obtains a claim to resources from the provider by incurring qualifying expenditures. So whatever that grant agreement, however that grant agreement is written, and that's going to define what the recipient government can spend the money on. Once those expenditures, assuming again they're in the time criteria of the grant agreement and they're allowable expenditures, once those allowable expenditures are incurred, that's going to trigger our revenue recognition here. So the book says here, no receivable or revenue should be recognized in connection with an expenditure-driven grant until qualifying expenditures have been incurred. So you've got to have a grant agreement in place. It's got to allow the spending to have occurred because grants have time periods also that the spending can start and the spending can finish in most cases. So we have to be aware of when spending can start, when it can end, and what's allowable. So that's government mandated non-exchange transactions. So that's also summarized here in the book on Exhibit 8-3 that explains or highlights just in a chart format for the receivable recognition and the revenue recognition for both a formula grant and an expenditure driven grant. So again, that formula grant, think of the funded mandate example where one level of government is requiring another level of government to provide a service. With that provider government also providing funding, is that the receivable and the revenue is recognized when eligibility requirements are met, including any sort of time requirement. So you have eligibility and you have time. And then secondly, for expenditure-driven grants, that's what I commonly see. Reimbursement type grants or where you have to outlay the cost and then you request reimbursement from the federal or the state government. Those expenditure-driven grants, the receivable and the revenue is recognized when the qualifying expenditures have been incurred. And then lastly, there's voluntary non-exchange transactions, and these also do incorporate grants. And again, there's different types of grants. So we already covered formula grants and expenditure driven grants, kind of the examples that I gave, but voluntary non-exchange transactions would really be anything that doesn't really fit in the first three categories. So that would just be any grants that doesn't fit the formula grant or the expenditure driven grant. But again, the revenue recognition, really, I guess the only difference that I'm seeing here in the exhibits between 8-3 and 8-4 is that it's still disclosing what a formula grant receivable and revenue would be. There could be expenditure driven grants that are contingent based. So we did not talk about contingent grants, or contingent grants did not fall under the second category here. I'm sorry, the third category here of government mandated non-exchange. But if there's a contingency on the grant, that contingency also needs to be met for a voluntary non-exchange transaction to be recorded. So the contingency, if you look under in the book under 8-5, so there's one practical difference in accounting and financial reporting between the government mandated non-exchange transactions and the voluntary non-exchange transactions. It's that reimbursement grants typically with voluntary non-exchange transactions typically require the recipient also to provide some sort of support, meaning a matching. Okay, so they're talking about matching grants here in the voluntary non-exchange transaction. So that just adds another level of requirement before revenue could be recognized related to any sort of matching requirement. So when we talked about the types of grants here, those grants were just strictly expenditure driven, no matching requirement. So there is no extra element to be required here. So in this situation for a matching, not only does the expenditure have to be incurred, within the period, be a qualifying expenditure, the matching also has to be met also. So one example that I've seen in practice is if you've got a grant where maybe the government that's spending the funds has to match, say, 20% of the cost. Let's just say they spend $100,000 on the grant, right? They're only going to request reimbursement for 80,000, meaning the other 20,000 is its match because it incurred the 100,000. It's going to pay for the 20,000 out of general fund money or whatever pocket of money it can. It's only requesting 80. Well, then at that time, you could still recognize that $100,000 cost because you've also met the matching criteria. And you can have grants where it's federally funded, state funded, some combination of that plus local. So you could have multiple funding arrangements, but just keep in mind that you're following the billing with what that requirement is in the grant agreement. Because maybe you have to match, it's fairly common that you have to match as you go along. So every dollar that you spend, if you're only going to be able to collect only bill 80, you can't recognize 100% now and then just wait till you get the last 20% of the grant and say, okay, that's my match. The matching may need to be done all throughout the spending, and in which case you would have, like I said, $100,000 expense today, $80,000 receivable and revenue from that provider government providing some portion of the funding versus being able to say, oh, I have a matching component. I'm going to take $100,000 expense and book $100,000 receivable and $100,000 revenue. That may be contrary to the matching requirement within the grant agreement. So any questions there? So really all the types of from a high level, right? The types of transactions we've covered here for non-exchange would be sales tax, income tax, property tax, grants. So that's pretty significant, or a lot of times that's, the main revenue streams, aside from the any sort of charges for services that we kind of went over, but that the accounting for those items is pretty straightforward. So that covers a lot of the material revenue streams, I think, here. So let's go to the next slide. So we did talk about when we talked about grants, we really talked about it from the recipient perspective. So that recipient being the one that's recognizing the revenue because they're the ones that are spending the grant. But from the provider reporting side, if the government that's providing the grant to an organization, really it's the same thought process, just in reverse, right? So when did that organization, if you're the provider government, when did the recipient government demonstrate that it incurred eligible expenditures? And then that's going to drive their provider reporting. So it's just kind of the other side of the transaction, when the recipient government has earned the revenue, the provider government is going to have an expenditure, more or less. I mean, there could be little timing differences here and there, but largely it's just the mirror image of the recipient government transaction. So this extraordinary items and special items, I will touch on this a little bit. Keep in mind so GASB 103 that just recently came out, that's the financial reporting model improvements. That is now effective for fiscal years 2020, or well, I should say for June 30s. I assume most of us are June 30, 2026, but GASB 103 is required to be implemented for fiscal years June 30, 2026 and moving forward. And that has affected the terminology here. for extraordinary items and special items, that instead of now using this terminology, it's really going to be now combined into one category, and there's no requirement now to then make a distinction between extraordinary or special items. So there's no distinction between the two anymore. And then now it's just really unusual and infrequent, and the within the control and management really isn't um, relevant at this point. So this terminology isn't used anymore. I won't go through this in too much detail then because you're never going to use this again. But just keep in mind, there are still elements of GASB 103 that points to like, okay, what is unusual in nature? What is infrequent? And I think I forgot the GASB that originally introduces this. There's a GASB that's pretty early on that introduces these concepts. So there still is relevancy in unusual and infrequent items. It just now really there's no distinction of using the term extraordinary items versus special items uh, category within the financial statements. I think the gaffer here has been updated for 103, but because unusual and infrequent items are not very common, they may not even have an example here, but let me see. Just bear with me. I was going to get to the examples later, but now curiosity is getting the best of me. Nope, they have yeah, and I can tell they have implemented this for GASB 103 because of the some of the terminology here. I just don't see the new terminology that you'd see on the face of the statements. Just give me a second here. I want to open GASB 103 and I can show you what the terminology is. So for any of you that do have to implement GASB 103 into your financial statements, there's a lot of good illustrations in the back of it, and I won't go through all of these because that's not the scope of this chapter. But in 103, they have lots of illustrations in the back. If I can get there. So maybe I went too far. Oh, here we go. I went way too far. So if we look at an example of the new terminology, instead of using infrequent or special, extraordinary items and special items. I'll make this larger once I find the page. Guess I need to know what example it is. Just bear with me. I've gotten this far. I'm not giving up yet. All right, hold on. Let me look at the table of contents here. So the table of contents, you'll see, all right, illustrations C1. I thought, because they have a table of contents for all the illustrations. Okay, let's see if we can find it. Because I would have thought they would have had an illustration that would specifically point out the new changes for unusual and infrequent items, but maybe not. I swear there was. All right, well, there's some light reading for you later to look for it, but I apologize. I thought I could find this much easier. But then maybe they don't have it either. Because this looks very similar to the gaffer that we're also looking at, is where like they've got the new terminology there. But all right, I'm sorry about that. So anyway, let me get back to the slides. These terms will not be used anymore, extraordinary and special items, but there still is, there still is recognition in literature to unusual items and infrequent. So events are considered to be unusual. And if you have the book, this is in section 8-7 about unusual items in nature. Events are considered to be unusual in nature if they possess a high degree of abnormality and are clearly unrelated to or only incidentally related to the ordinary and typical activities of the entity. An event is infrequent in occurrence if it would not reasonably be expected to recur in the foreseeable future, taking into an account the environment in which the entity operates. So these are really abnormal items that are occurring. If those elements are met, there's the opportunity to disclose, or I should say, report those transactions outside of the operating revenue, or I know we're not really technically talking proprietary funds, although this terminology does apply to proprietary funds, even though we haven't really gotten into that yet. But this concept applies to both governmental fund reporting as well as proprietary fund reporting. And if there is an element that meets criteria for recognition, it would really be below. I know we're in the business type activities here. It's really below all the activity. So it wouldn't be in operating. It wouldn't be in non-operating. It would be below here as its own additional category. And then if we're talking governmental funds, it would be, again, not in revenues, not in expenditures here, not in other financing sources, but it would be another category here for the unusual and infrequent items. Okay. So just keep in mind this terminology here is a little stale, but GASB 103 is kind of hot off the press for implementation here for fiscal year 2026. And then the last part of the chapter talks about direct changes to net position. So there's really two reasons why there would be a change to net position. And when we say direct change to net position, that's changing the opening net position that was reported at the end of the prior fiscal year. So if you're closing 2026's books, you're generally starting with the opening net position or fund balance, if you will, for the funds, unless one of two things happens. There's a prior period adjustment. There's two common types of prior period adjustments. One would be correction of an error. That's, whoops, we made a mistake and now we need to fix it. And, typically, if there's a material misstatement or error in a prior period, you would adjust the beginning balance so that way that impact to net position isn't flowing through current year operations. Or secondly, which is more common, would be the implementation of a new standard. So, there's been examples where when GASB 87 for leases came out, some people had a restatement. For GASB 101 for compensated absences, that's not an uncommon result of a restatement. So implementation of a new standard would be considered a prior period adjustment. And then there's certain circumstances where a government could go from acceptable accounting standard 1 to accounting standard 2, which would then result in a change in how, an asset would be reported. And then those would also be changes to net position or fund balance. I don't see that very often. I don't know if I've ever seen a change in an accounting principle from one method to another, but I do see lots of prior period adjustments for implementation of a new standard. And I think the sample gaffer you have here does show an example of that. Again, this is just giving you the picture of how it looks within the financial statement. So this is the entity-wide statement of activities, and they did have a prior period restatement, net position beginning of year as previously presented. Okay, the restatements here. So this was before the restatement, and then they had some sort of restatement here, which I'm sure if we go read the footnotes, we could find out about. Uh, but that's showing that this is what the statements would look like if there is a restatement. Or you could just change net position beginning of year. You could do comma as restated, combine these two numbers, and then elaborate in the footnotes about what that restatement is. So there's two presentation options here. One is showing net position. That's really hard to just highlight one number. I guess I can't. Net position. I don't like the blinking either. All right. Net position as it was previously reported. Here's the adjustment. Here's our new restated net position. Or you could combine this number up here, just have net position beginning of year as restated, and then basically put this into the footnote. So I've seen both examples. All right, and that's chapter 8. Any questions there? Questions, comments, concerns? All right. I think I'll go through chapter 9, then probably give us a little bit of a break. Um, so chapter 8, yeah, so that's what I'll do. I'll get through chapter 9. We'll take a little bit of a break and come back and get through more of the chapters. So chapter 8 was about categories of transactions and their recognition. This talks a little bit more in depth about revenue recognition in governmental funds, which, we did talk a little bit about that. Well, we talked about the transactions and how they would be recognized. Chapter 9 is going to talk a little bit more about the accounting model or the requirements for revenue recognition. Like how I mentioned before briefly, is that there's an availability criteria to revenue recognition that in many cases just earning the revenue and having a receivable isn't the end all be all for revenue recognition. There's also an availability component to that as well. So we'll get into the model here that we're using, the modified, and I mentioned the modified accrual basis of accounting. Again, we're still in the governmental funds. Governmental funds are following the modified accrual basis of accounting, which is a blend between cash basis. It doesn't go as far as just cash basis because the governmental funds do have receivables, right? If you're on cash basis, there would be no receivables. So it's kind of in the middle between cash and accrual. On the other hand, accrual would be, okay, you book your receivable when you've earned it, and collection has no impact on the earning of the revenue. But because these governmental funds they're focused on near-term liquidity. And governments a lot of times are budgeting more on, kind of like cash in a way, kind of cash in, cash out, rather than full accrual. The financial statements are going to follow this kind of blend, if you will. So chapter 9 starts with just giving a little bit of background on the governmental fund revenue recognition basis here, but it says under the accrual basis of accounting, and this is again full accrual. This is, when we get into enterprise funds, that's accrual basis of accounting. So under accrual basis of accounting, revenues are recognized when an entity obtains a legal claim to resources, regardless of when collections occur. So full accrual accounting, the element of collections don't matter. Under the cash basis of accounting, again, this is looking at the two extremes, if you will, before we talk about modified accrual. Under the cash basis of accounting, revenue must be earned and collected before it could be recognized, right? Cash basis, you have to collect it. It's cash. So that is the accrual basis of accounting has a single recognition criteria. That's earning, right? Under accrual basis, all it matters is was it earned? Whereas a cash basis has two recognition criteria, earning and collection. So earning and collection has to occur. Government funds focus on current financial resources. And I know that was introduced earlier in today's training. So, governmental funds, current financial resources, also known as near-term liquidity. So, establishing a claim to financial resources, the earning of financial resources affects near-term liquidity only to the extent the resources will be collected in a relatively near future. So those resources need to be collected in a relatively near future. So this is where we're getting to a time element involved in revenue recognition and governmental funds. So thus the accrual basis of accounting is too broad of a definition or a requirement for funds whose measurement focus is current financial resources. So consequently, the accountants have created a unique basis of accounting, and I would say governmental fund statements are very unique. So they've created a unique basis of accounting for governmental funds that might be described as falling somewhere between the accrual basis of accounting and the cash basis of accounting, and that is called the modified accrual basis of accounting. So on the modified accrual basis of accounting, it's similar to both the accrual basis of accounting and the cash basis of accounting in so much that resources cannot be recognized until revenue is earned. So that's still true. Revenue must be earned. But it also differs significantly from both cash basis and accrual basis recognition because one is under the modified accrual basis of accounting, the earning process alone is not sufficient for revenue recognition. And revenue recognition can occur before the amounts are actually collected, like the accrual basis of accounting, but unlike the cash basis of accounting. So we still have this time element that we have to consider. So under the accrual basis of accounting, earning alone is not sufficient. And then revenue recognition can occur before the amounts are actually collected, which means it's not cash basis, nor is it full accrual basis. So under modified accrual accounting, we have this concept that amounts must be earned, measurable, and available. So it's got to be earned. And we talked about in the last chapter, how is it earned? Derived tax revenue, the underlying transactions taking place, property taxes, we talked about that. So it's got to be earned, measurable, and available. So what does that mean? It has to be collectible within the current period or soon enough thereafter to be used to pay liabilities of the current period. So that availability criteria, we have a little bit of judgment here, right? It's saying collectible within the current period or soon enough thereafter, which means the receivable could be collected after year end, and that collection of those receivables would be used to pay current liabilities. So I'll read this again from the book. So when amounts must be earned, measurable, and available. Available is basically collectible within the period or soon enough thereafter to be used to pay for liabilities of the current period. So let's expand on that a little bit more. Let me make sure slides I'm still good. Okay, get back here. So how do we apply this concept? So revenues should be recognized in governmental funds as soon as the government obtains a claim to resources. That's modified accrual, but only to the extent that the resources will be received soon enough to be used to liquidate liabilities of the current period. Note that the modified accrual basis of accounting this modified accrual basis of accounting has no effect on asset recognition, meaning the receivable side of things. So when the receivable is collected, or this availability criteria does not impact the receivable, it's going to impact revenue. So we're talking about a classification now on the credit side of the transaction, which is either going to be revenue or unavailable revenue or unearned revenue. Well, yeah. So, in other words, governments always recognize a receivable as soon as they have an enforceable legal claim, regardless of whether those resources are considered to be available. So now let's get into availability. And if you have the book, that's going to be in section 9-3. So now let's talk about availability. So as a practical matter, each government must decide on a time frame within which amounts must be collectible to be recognized as revenue. Accountants describe the time frame selected for this purpose as a government's availability period. So now we're going to talk about the 60-day rule. The selection of an availability period is essentially a matter of professional judgment. And again, I alluded to the fact that we have some judgment here about what we considered available, right? Because going back to what the book says, it's collectible within the period or soon enough thereafter to pay for liabilities of the current period. Like how do you put guardrails around that, right? We've got professional judgment we can use. However, there is one rule that we have to consider. So we get to use professional judgment. However, GASB requires or sets a 60-day maximum availability period specifically for property taxes. So basically for property taxes, there's a 60-day window after fiscal year end. That's defined as the availability period or the collectability period for revenue recognition. So for property taxes, whatever June 30, 20, what June 30 receivables are sitting on the books at year end, if those receivables are collected within the next 60 days, if we have a June 30 year end, the July and August collections, that's going to count against the revenue. So whatever, if 100% of those property tax receivables come in within 60 days, 100% of that receivable, the credit side is going to be revenue. Let's just say contrarily, if only half the receivables come in, let's just say we had a $3 million property tax receivable, 1.5 million came in the next 60 days after year end, 1.5 million didn't, we're going to have a $1.5 million unavailable revenue figure that's going to kind of defer, if you will, the recognition of half of that receivable balance because it's not available. It has not met the availability criteria. Although it's been earned, so the full amount of the receivable gets recognized, but because the availability has yet to have been demonstrated, that's hung up the revenue recognition for the rest of that receivable. But that rule is only required for property taxes. But many governments I've seen have taken the 60-day rule and also apply that to other revenue streams as well. But it's got to be so it's a long-winded way to say for property taxes it must be 60 days. It's not required to be 60 days for other revenue streams, but there has to be some sort of policy that the government sets for that availability criteria. There has to be an availability component to this for the modified accrual basis to be followed. Any questions there? Okay. So that's the availability criteria. So going back to the slides here, so we talked about modified accrual really being a blend between cash basis and accrual basis, largely coming down to revenue recognition and this availability criteria. This availability criteria you will not see in cash basis, you'll not see in accrual basis, and you're only going to see it in governmental fund financial statements. Availability doesn't matter for proprietary funds. Availability doesn't matter for our entity-wide financial statements, but it matters for governmental funds, our general funds, our special revenue funds, etc. So that's a huge difference in our governmental fund financial statements. Now, there is a little bit of a caveat here. I'd be careful to, to use this out kind of liberally, if you will, but it does explain in section 9-4 of the book that if there could be an unusual circumstance where if you strictly apply the normal availability period rule, meaning like if you got a 60-day rule and you're not if the government if you as a government if you're used to collecting a large payment within 60 days, but that payment comes in like on the 61st day, there is some reasonableness, or judgment you can apply to say, well, this, to meet the spirit of what we do, we just had this huge transaction that just was right outside the 60-day rule. Now we have this big distortion in our financial statements because of, collecting something maybe a day later. There is an opportunity or an out, if you will, to let kind of common sense rule the day. So, you could have that in your back pocket in case, someone's telling you, wait a minute, it was 60. Is it, that could kind of avoid the argument of 61 days versus 60, especially if that's really kind of distorting your numbers. But there, GASB does allow for in unusual circumstances, the government can recognize revenue based on its normal collection patterns. So just keep that in mind. A government, and this highlights or italicizes in unusual circumstances, a government can recognize revenue based on its normal collection patterns. So the book further goes on to go through some journal entries. I'm not going to beat journal entries up too much for our time here, but you'll see, as I mentioned before, receivables need to be booked at really their net realizable value. So you want to consider any uncollectible amounts and record receivables net of uncollectible amounts. So that's just giving you some journal entries as far as how that could be recorded. So it's giving a couple examples here that of how can you set up those initial transactions. So in this case, it's giving an example of, okay, a government now has claim to a receivable for $500, but it's expecting that ultimately, $5 of it or 1% of it's going to go bad. So how could you set up that entry? The day that you get the claim to the receivable, you could have a debit to accounts receivable of $500, a credit to the allowance for doubtful accounts to set up that reserve, and then recognize the credit for revenue for $495, meaning that now there's that 1% allowance that's been factored in. So the one way to do is to record the receivable all up front and then record the revenue. Now, but keep in mind at a later time, we still have to consider the availability. So if you on day, if we're in the middle of the fiscal year, you could have a receivable, today, you could recognize the allowance and the revenue, but at June 30 and thereafter, we still have to consider the availability. So we would potentially have to adjust the revenue at a later date. But as of today, we could say, all right, we're going to book the receivable and the revenue at net realizable value. Or what you could do is record that as a deferred inflow of resource. So it's giving you just some examples here throughout the entries. And I'm not going to walk through each one of them, but you can set up the receivable and the revenue kind of as it occurred and then adjust the receivable or adjust the revenue after year end. Or you could recognize basically the receivable, defer all the revenue, and then at year end, calculate what your revenue is. The idea being ultimately the availability criteria has to be followed, and that unavailable revenue is going to be whatever was not collected within the 60-day window, or if that time period's different, for different revenue streams that aren't income taxes. So then there'd be that unavailable revenue and that revenue adjustment kind of after that availability period has occurred. So it goes on to just after the journal entries discusses really the accounting, and I think we talked about this a little bit in the previous chapter, but it goes through the specific applications to the derived tax revenues that we talked about in the last chapter. So if we talk about, if you got the book, it's on page 9-7 about sales tax. So again, that's a specific example of derived tax revenue. It says ideally sales tax receivable should be recognized as an asset as soon as the underlying sale has occurred. This receivable should include anticipated recoveries. Basically, you're not going to collect it all. Revenue should be recognized net of estimated uncollectibles. Again, that's the example where, any bad debt or uncollectible amounts, you're not recognizing all the revenue for that. And then also only recognizing amounts as they are available. So we have to think of that 60-day period or whatever that period is defined at year end. So I don't think that's too different from what we talked about in the prior chapter when it talked about receivable and revenue recognition. And it's got income taxes here. Ideally, income tax receivable should be recognized as an asset as soon as the underlying transaction, meaning the earning of income, occurs. Revenue should be recognized, very similar to sales tax, net of estimated uncollectibles, and only as amounts become available. Prior to that time, the unavailable portion of the receivable should be matched by a deferred inflow of resources. So if there's any unavailable revenue, meaning the availability criteria hasn't been met, we're going to have a deferred inflow of resources. And then it goes on just to explain the accounting for our imposed non-exchange revenues. As we previously discussed in the last chapter, that's what? Property taxes, that's fines and forfeitures are examples of imposed non-exchange revenues. So for property taxes, so normally a receivable for property taxes is recognized as soon as an enforceable legal claim is established. That's typically referred to as the lien date or the assessment date. However, in certain cases, the fiscal period of that property taxes are intended to finance may actually begin prior to this date. If so, the receivable for property taxes should be recognized at the start of the period that the taxes are intended to finance. Put differently, a receivable for property taxes should be recognized as of the date a legal claim is established, which we discussed before, or at the start of the period that they are intended to finance, whichever is earlier. Fines and forfeitures also meet the definition of imposed non-exchange revenues. Thus, revenue or a deferred inflow, meaning the unavailable portion, should be recognized as soon as an enforceable legal claim is established. In the case of citations that are undisputed, meaning they're not going to go to court, revenue recognition should occur when payment is made or when the legal period for challenging the citation has ended, whichever occurs first. So that's for undisputed citations. For disputed amounts, recognition occurs when a fine is imposed by the appropriate legal authority, such as a court. And again, you want to consider your net estimated amount of refunds on those amounts. So again, you still want those receivables at net realizable value. Let's see, next slide. So it talks more about revenue recognition or the receivable and revenue recognition for our government mandated. Well, I guess I can touch a little bit on escheat property here. So that is another category. It's not uncommon that I see governments with some sort of escheat property. So there is a little section here on escheat property. And that's when a government takes custody of private property when its rightful owner cannot be found or identified. Such this property is called or is said to be escheat or escheated, reverted to the government until the rightful owner can be identified. Typically, or what commonly happens is a substantial portion of this escheat property will never be reclaimed by the individual. So governments frequently elect to account for escheat property in the general fund. In that case, they should report a liability in the fund equal to the amount ultimately expected to be paid out to claimants. So if you've got the cash or you've got the asset, that's going to be offset for a liability for what's expected to be paid out to claimants. For any amount that's not expected to be paid out to claimants, the remaining balance would be recognized as revenue. So that's one little caveat there for the escheat property revenue recognition. That wasn't really dealt with in Chapter 8. Then it gets into the revenue recognition a bit here for concepts we did talk about in the last chapter. This is our grants, if you will, or different types of grants. The government mandated and voluntary non-exchange transactions. So again, it deals with, if you look at the slide here, different types of grants. So it kind of redefines what government mandated non-exchange transactions are. I won't go back through that, but it talks about intergovernmental revenues, and that can be really split into the broad categories of entitlement grants or, formula grants that we had talked about. And then on the other side of the coin being the expenditure-driven grants or the reimbursement type grants that we referred to. So entitlement grants or formula grants. For grants based on a formula, a receivable and revenue / unavailable revenue should be recognized as soon as all eligibility requirements have been met. Constraints on how grant resources may be used do not constitute an eligibility requirement and do not affect revenue recognition. When the grantor is a government and the grant agreement does not expressly incorporate a time requirement, and this is similar to what we heard in the last chapter, the grantor's fiscal year is treated as the functional equivalent of a time requirement, meaning, or in other words, no revenue recognition prior to the start of the fiscal year of the grantor in which the resources will be provided. In situations involving grant monies that pass through multiple layers of government, the appropriate fiscal year is the fiscal year of the immediate provider. Then we have expenditure-driven grants. Those are our reimbursement style grants. The recipient of reimbursement grants obtain a claim to resources by incurring qualifying expenditures. Reimbursement grants that are voluntary non-exchange transactions also typically make eligibility contingency upon some form of matching. So we talked about matching. And that's also referred to as the contingency. So when you hear contingent grant or contingency on a grant, that's the matching element of the grant. So a receivable and revenue or a deferred inflow of revenue for the unavailable portion should be recognized only when both the criteria have been met. So the qualifying expenditure plus compliance with the matching or the contingent requirement. Just keep in mind that if the grant agreement has an administrative requirement, such as just filing a report at the end of it, this does not impact revenue recognition. So that filing a report at the end of a grant period of like performance metrics or just saying, hey, here's how we use the money, that does not impact revenue recognition. That is not any sort of eligibility component. And I've seen that that can be a little bit confusing of like, have we met our eligibility criteria? But an administrative step, if you will, or filing a report does not delay or affect revenue recognition for grants. So just keep that in mind also. It's not uncommon for governments to enter into payments in lieu of taxes or pilot transactions. Sometimes an organization is exempt from paying a tax, even though it benefits from the services funded by that tax. In that case, the beneficiary may agree to a pilot, and that's again a short for payment in lieu of taxes. The amount of the pilot is not equal, or it's not an exchange, or a lot of times it's not a exchange like transaction. So it's not, a lot of times pilots are not equal or almost equal to the cost of the services provided, meaning that pilots are normally properly classified as voluntary non-exchange transactions rather than exchange or exchange-like transactions. So if there is a pilot that meets this definition, a government should recognize a receivable as soon as they meet all applicable eligibility requirements. Um, there's some discussion here on pass-through grants, and I won't walk through each one of these examples. I'll touch on pass-through grants. That may be something you all see in practice. So sometimes the grants require the recipients to transmit the proceeds to a third party. So again, you could be like kind of in the middle of, maybe if you're a county, you could get federal funding that comes to the county that then maybe goes to a town or another government. So if that's happening from the vantage point, I guess, well, the example here in the book is, for example, federal funding aimed at assisting local school districts often must first pass through the state before reaching the intended target. So the example here is you got the federal government, the state, and then ultimately the school district. From the vantage point of the intermediate grantor, the state, who's in the middle of this transaction, passes, is performing a pass-through arrangement, which is functionally equivalent to an expenditure-driven grant, with payouts to secondary recipients constituting the qualifying expenditures. Accordingly, an intermediate grantor should recognize revenue only as the grant resources are remitted to the secondary recipient. So really you've got a revenue and an expenditure happening really simultaneously. So there should be no impact of net position or fund balance from a pass-through grant. Well, I guess I take that back with one small caveat, because there is, due to the period of availability, there is the potential for a mismatch in the timing of revenues and expenditures. So I guess just keep that in mind. But there could be a timing issue because of the availability criteria. But generally speaking, that pass-through grant, you're going to have an expenditure and you're going to have a revenue match. I'll skip on behalf payments, federal food stamps. See, I don't see endowments too much from a government perspective. Just keep in mind, and I know there's different funds that we'll be talking about through this course, and proprietary fund accounting is different from governmental fund accounting. But when we're talking about governmental funds, for the receipt of donated capital assets, a government fund is reported on current financial resources. So consequently, donations of assets that will be used in operations are never reported in the governmental funds. So donated capital assets are typically not reported in the governmental fund financial statements. They however, reported in your enterprise funds, and you see that. Oops, let me flip these statements around a bit. We'll take a break here in a minute, guys. Rotate clockwise. So it's not uncommon, especially in the business type activities, for a developer to, build an asset or build out maybe the water as part of the water system or sewer system as the development of a neighborhood or a property, and then turn that asset over to the county or to the government because the developer doesn't want to have to maintain infrastructure, right? They want to move on to the next project. So it's, fairly common for a business type activity or a proprietary fund to have donated capital assets. As such, that would be reported in the not other non-operating revenue section where we've got capital contributions. A lot of times those are donated, um, if you will, donated assets. You're not going to see capital contributions in the governmental fund financial statements. If a donated asset is quote unquote general fund related, that's going to go into the governmental activities fixed assets, right? Because the general fund doesn't report fixed assets. So just like if the general fund purchases a fixed asset, it's going to get expensed, but that's going to get capitalized on the entity-wide statements as capital assets. Same thing, if a governmental fund receives a donated asset that otherwise should be capitalized, it's going to be on the entity-wide financial statements as a capital asset, but it's not going to be on the general fund, or it's not going to be in the governmental fund financial statements. Any questions there? Every now and then I do deal with donated asset questions or even you get some issues, well, not issues, but the nuance of like transferring assets between general fund and proprietary funds, where the or governmental funds, and because the governmental funds don't report the asset, you're not recognizing the transfer in or the transfer out of an asset, of a capital asset, where you would do that on the enterprise financial statements. So it's really like an entity-wide type reconciling item rather than a fund level transfer or reconciling item. So going back to the slides, talked about donated capital assets. I don't think there's anything too magical about investment income. It says on 9-12, government funds are required to report certain investments at fair value. Any increase in the fair value of such an investment is automatically considered to be available and thus recognized immediately as revenue. So basically, changes in fair value of investments, we don't have to worry about the availability criteria. And then it further says earned interest may be recognized as revenue. Um, well, earned interest may be recognized as revenue only as it becomes available, but the increase in fair value is automatically considered to be available because governments must report investments at fair value. Lease receivable, that's just really kind of talking about, that's more of a GASB 87 item. So I know we've recently gone through implementation of lease standards. So I won't go do that in any detail unless there's any question. I think that sums up what I wanted to cover for chapter 9. So I think we're making pretty good headway here. Why don't we take about a 15-minute break and then what do we got here? It's about 2:30. So at 2:45, let's pick back up and we'll knock out a couple more chapters and see where we are time-wise. But when we get back, we'll pick up on chapter 10 and go through expenditure recognition in governmental fund financial statements. So again, let's take about a 15-minute break and I'll see you guys back at 2:45. Sound good? All right, we're recording again. All right, so let's pick back up here on chapter 10. We spent a last couple of chapters talking about revenue recognition, which can get a little tricky with this availability criteria that we talked about. I think expenditure recognition will be I'd say a little bit more straightforward, but it's also more, I'd say we'll talk more about exception-based reporting. Because there's a basic rule we'll talk about for expenditure recognition, and then there's basically exceptions to that rule that we'll talk about. So it'll make sense as we get into it. a bit here. So let's go here. Oops, got my one slide here. So let's talk about the basic rules. So if you got the book, that's going to be on 10-2. Again, we're still talking governmental funds. We're still applying the modified accrual basis of accounting that focuses on near-term liquidity. So we're still under those same rules that we've been discussing all morning, really, or from then till now. So what's the basic rule for expenditures? So thus, in the absence of an explicit requirement to do otherwise, a government should accrue a governmental fund liability and expenditure in the period in which the government incurs the liability. So again, in the absence of an explicit requirement to do otherwise, which we'll get into those exceptions in a second, a government should accrue a governmental fund liability and expenditure in the period in which the government incurs the liability. In accordance with this basic rule, salaries, professional services, supplies, utilities, travel, and similar items are recognized as expenditures in the period in which the government receives the goods or services. So let's get into the exceptions of the basic rule. So while the basic rule for expenditure recognition is the same one used for expense recognition, keep in mind for governmental funds, we're calling these expenditures. In our enterprise funds, our business type activities, our entity-wide statements, we're calling them expenses. So there is a difference in terminology here. So again, these are expenditures. So going back to these exceptions, while the basic rule for expenditure recognition is the same one used for expense recognition, there are a number of critical exceptions that make expenditure recognition under the modified accrual basis of accounting. So again, this is only applied to our governmental fund expenditures, not anywhere else in the reporting. So there's an exception for debt service and payments on long-term lease liabilities, certain specified accrued liabilities that we'll get into, pension and other post-employment benefits, leases, and prepaids. So additionally, governmental funds report expenditures for capital outlays in connections with capital assets rather than depreciation and amortization expense. Expenditures for capital outlays are recognized when a liability is incurred. So let's cover the exception for debt service on long-term debt. Often debt service payments for long-term bonds are made semi-annually with a given payment period crossing fiscal years. Under the accrual basis of accounting, interest expense must be accrued for the portion of the payment period prior to the end of the reporting period. So again, we're talking about a difference in payments for debt service and interest accruals, right? So the example they give is a situation where they're calculating basically accrued interest based on timing differences of fiscal year end and the next debt service payment, meaning that, calculating here $125,000 accrual of interest expense at the end of the fiscal year end. But however, a key objective of the current financial resources measurement focus is to provide information that is useful for those making decisions in the context of the operating budget, right? So we're on modified accrual accounting, focus on near-term liquidity, really because of budgeting. So as a practical matter, the entire amount of each interest payment normally is budgeted in the period in which the payment is due, even if that payment, straddles 2 fiscal years. So accordingly, the modified accrual basis of accounting calls for interest to be recognized when the expenditure is due, right? So when is that interest payment due? Thus using Thus, using the previous example, no expenditure would be recognized for interest as of the end of the reporting period, right? Because on an interest accrual, that interest payment isn't due until after fiscal year. This fiscal year period is just a timing element between when the previous payment was made and when the next payment is made. So no expenditure would be recognized for interest at the end of the reporting period. Instead, the full amount of the regular semi-annual interest payment, which in this case, the full payment in the example is 250,000, will be made later after year end. That is going to be recognized in an expenditure when due, which is in the following period. So instead of splitting this $250,000 interest payment that's going to happen after year end and calculating how much of the time period was in, the fiscal year we're accounting for versus the next fiscal year, we're not splitting it and we're not accruing interest expense. Likewise, debt service principal payments are recognized as expenditures when due. Thus, no current period expenditure normally would be recognized in connection with debt service. Principal and interest payments due on or after the first day of the following fiscal year. Okay, so we're not accounting for transactions that happen in the next year, right? So no expenditure normally. So no expenditure normally for payments that are made or due, I should say, for payments that are due on or after the first day of the following year. Further goes on to say sometimes governments are required by bond resolution or covenants to transfer resources to a debt service fund for principal and interest payments due early the following year. Such transfers can temporarily inflate the debt service fund balance beyond its normal level, which then could confuse some financial statement users. Therefore, if a government is required to transfer resources to a debt service fund prior to the end of the period, for debt service payments due early the following year, the government has an option of recognizing the debt service expenditures in the current year, even though payment is not due until the following year. So that's a very specific or long example there, but there is an out for if a government is required to transfer resources to an enterprise or to a debt service fund that then is going to make a payment early in the next fiscal year, there is an option to recognize debt service expenditures in the current year, even though the payment is not due until the following year. I don't know how often I see that in practice, but just keep in mind there is an option in that situation. But again, it's got to be defined by some sort of bond covenant, bond ordinance, bond document, and transferred to a debt service fund. So this again is not in the general fund. This is being transferred to a debt service fund. And it's also impacting the, a short-term basis, impacting the fund balance of that debt service fund by that transfer. So there's an option to expense those resources when they're transferred. And again, that also depends on the timing of when that debt service payment is made. It does say here specifically within 1 month. So when we talk about the debt service payment is due early the following year, it needs to be within 1 month after fiscal year end. So it gives some journal entries here. I'm not going to go into journal entries. One thing I will highlight just to make reference, I do like the nerdy side of me likes the financial statements and what they look like. But if you look in the governmental fund financial statements here, like I mentioned, this is the only statement where we're going to see expenses, if you will, pardon me for saying that, but expenses recognized using the term expenditures because we have this modified accrual basis of accounting we're following. It's not full accrual, so we're not using the term expense here. We're calling it expenditures. So just keep in mind that there's a different um, term. We're not using expenses in the governmental fund financial statements. We're using expenditures. And our debt service principal and interest payments are shown separately from these functions here. So like these are different functions of the government, general government, public safety. Largely you're going to have payroll costs in there, fringe benefits, operating, vendor costs, things of that nature. But the debt service principal and interest payments are going to be shown separately from the fund that's actually paying it. So in this sample gaffer here is the debt service fund is paying the principal and the interest, whereas the general fund isn't. Now that's not necessarily a requirement. GAAP will allow whatever fund is paying the debt to get the recognition of that expenditure. But in this case, the debt service fund in this example is paying all of the governmental fund debt and interest. So that's where, in this caveat with the transfer of the debt made, where a principal and interest payment is going to be made within the first month of the next fiscal year, there's the option to expense those resources at that time. Really, then you'd have a liability reported on the balance sheet and an expense, and then that would not I use this term loosely, but artificially inflate, if you will, or temporarily inflate fund balance when that transfer had been made for a payment that's due within 1 month of the year. So that's just the visual effect of where you're going to see those debt service principal and interest payments. So there's a bunch of, journal entries that kind of show from a cash flow perspective how that's all drawn out. And if the general fund does transfer resources to the debt service fund, those transfers are going to happen down here. And we are going to talk, I think it's the next chapter, but in a little bit, we'll talk about other financing sources and uses. And this is an area where GASB will define for us what specific situations or transactions qualify to be reported down below the revenues and the expenditures. Because GASB is very specific in what can be considered an other financing source or use. It has to follow GASB's definition. But one thing that we'll talk about is transfers. And if a government, and there's all kinds of transfers going in and out between funds, but if a government is transferring, general fund resources are transferred out, going into the debt service fund to then pay principal and interest payment, that's going to come through as a transfer in. And that's some of the journal entries that you'll see discussed. But I think it's just easier to show it here on this screen that a general fund could, or really any fund, probably if any fund's going to transfer money to the debt service fund, I would think on average it would be a general fund. That's not to say there can't be other funds transferring money into the debt service fund, but if cash is transferred in to the debt service fund, that's going to be really a debit to cash in the debt service fund, a credit to transfer in, which that transfer is increasing the fund balance. That transfer of cash is increasing the fund balance for the debt service fund through a credit, if you will, to transfer in. So we'll get into some fun with other financing sources here in a bit. Excuse me. All right. So page 10-4 goes through entries. 10-5, this is where we'll talk about exceptions for certain specified accrued liabilities. So And this is where I think if you're used to financial statements and the entity-wide financial statements and what's included in the entity-wide versus the fund level, this will make sense. But the exceptions that of the expenses that are not reported in the fund level financial statements, but are entity-wide types of expenses are listed on 10-5. So the certain accrued liabilities would be compensated absences, claims and judgments, termination benefits, landfill closure and post-closure costs, pollution remediation, and asset retirement obligations. And a lot of these liabilities, if you look in your government's long-term liability roll forward, most of those will be summarized in that section. So if you look, let me see if I can find it in the sample ACFR. I know I struck out looking at GASB 103, looking for that unusual or frequent item, but okay, here we go. So if you look in your, in this illustrative ACFR, if you look in your government's financial statements and you go to the long-term liability roll forward to get a sense of like what types of liabilities would be on the entity-wide financial statements, but not reported in our governmental fund financial statements because they're not expenses, they're expenditures. Well, this gives you an idea. Net pension liability, that's not due and payable. That, the liability has not been incurred for pension benefits. That's a liability that is calculated based on actuarial estimates that are due, over time, really. So the net pension, the pension related liabilities, lease liabilities, subscription liabilities, compensated absences, these are entity-wide liabilities. And I'm saying the associated expenses with it. I know we're talking liabilities here, but this is the balance sheet side of it, which of course has a expense effect to it too. But compensated absences is really the value of all the time that's expected to be taken and used and paid out in the future. But that's not a general fund or a governmental fund liability today. That's not due and payable. That's not a liability. That's not a liability that's going to be liquidated with current resources. It's not like on July 1st, there's going to be a $6 million check cut for compensated absences, right? That's time that's going to be really used, maybe paid out in the future over the next year, over many years. That same thing here with claims. That's another one of the examples in the book on 10-5 where it talks about claims and judgments, net pension liability, net OPEB liability. So these are examples of liabilities and the related expenses that are not general fund expenditures. Now, what could create, and I'm kind of shooting from the hip here, we'll go back to the book and kind of go through it in order, but compensated absences, right? That's based on a calculation. That's based on an employee's future separation. That's based upon an employee's future use of the liability. That's not a general fund liability. That's not a general fund expense. But let's just say, if I work for a government, if I retire at June 30, right at the end of the fiscal year or during the fiscal year, and I'm going to get a payout of my compensated absence balance. Well, if I quit and that payment is due to me, that does turn into a liability within the governmental fund or the general fund, because now that's a current liability. That's due and payable to me. So there are instances where these liabilities or this activity can be a general fund liability, but it's not just based upon the balance, right? So again, if I were to retire and my liabilities now due to me, like whatever that calculation is of what I would get upon termination, if I've separated, that does convert that liability into a current liability. That's now due and payable. That's going to meet the criteria of a general fund liability and expenditure. So some portion of this, and it would still technically also be in this compensated absence number. So some of this 5.9 million can convert to a general fund liability. Most often that's not the case, or it's very immaterial. But the concept of compensated absences, even the amount due within 1 year, even whatever amount you expect to pay of this $5.9 million in the next year has zero impact on the general fund. What will impact the general fund liability is if there's a separation and now that actually becomes due and payable. And that would then be a liability that's expected to be liquidated with current resources. So it's not as cut and dry to say compensated absences is only an entity-wide or a long-term liability. Generally speaking, more often than not, yes. But it's also based on the circumstances. Same thing with a claim. This claims, and I I don't know all the ins and outs of how this was estimated. Again, these are just a sample set of financial statements. But if this is an estimate of claims that a government's expected to settle sometime in the future. But if there's no invoice, if there's no amount that's due and payable during the fiscal year, that's all going to be a long-term liability. Conversely, if that payment's due, if they get notice that, oh, okay, we have to make this settlement now, well, you could have a current liability um, from that perspective. Again, pension liability, that's based on actuarial calculations. There's no amount due and payable. It's the government's decision to fund the annual required contribution, but even the annual required contribution doesn't necessarily trigger a governmental fund liability because that's really at the discretion of the government to make that contribution. Now, however, if we're talking, say, about OPEB benefits or an OPEB plan, if the general fund gets an invoice and if they're paying premiums for retirees and those payments are paid through the general fund, well, yeah, an invoice of premium payments due to an insurance company, that is due and payable. That meets the criteria to be a liability liquidated with current resources. And that would be an example of an OPEB type related activity that would meet the definition of a governmental fund liability. But generally speaking, these are long-term in nature, and that these typically are not going to qualify as governmental fund financial liabilities. Questions there? You guys are being too easy with me on the questions. All right, so where do I want to go next? Let me go back to the financial statements here. Just bear with me. All right. Oops, I'm still in the enterprise funds. Pardon me. All right. And really, again, I do like financial statements. So the differences between the governmental fund financial statements and the expenses, I know we're talking about expenses here, or expenditures, and the entity-wide financial statements and the expenses, a lot of that activity, whatever the difference is between modified accrual accounting and if quote unquote full accrual accounting or regular, I hate saying regular because it makes it sound like this is irregular, but regular accrual accounting, there's a reconciliation. I believe Toby touched on this, but there's a reconciliation between the fund level financial statements and the entity-wide financial statements. And whatever is on that reconciliation is the difference in recognition between your government fund financial statements and your entity-wide financial statements. So when you look here, and this is the statement or the page after the statement of revenues and expense and expenditures for the governmental funds. these balances here are having a these are the differences between expenditure recognition and expense recognition. So when we talk about compensated absences, for example, where is that? What this is saying here is that the entity-wide financial statements, because the governmental fund financial statements are not capturing compensated absence expenditures, because well, if there are none, right, the compensated absence expenses have to get captured on the entity-wide statement. So they're capturing $380,000 of compensated absence expense in the entity-wide financial statements that do not meet the definition of a general fund or a governmental fund expense. So this reconciliation is really showing you the differences between the modified accrual approach to the full accrual approach. So when we talk about these exceptions for on the slide, when we go back to the slide and we talk about exceptions for certain types of liabilities, right? I gave the example of compensated absences, so that's here. That's on the reconciliation from fund level to entity wide. It mentions claims. Let's see, we have claims on here. And claims must be buried in another line item. So we have the claim, we have termination benefits, which I don't think they had on the sample here. Landfill closure and post-closure, which I don't see them having it on here. But they do have pension. They do have pension and they do have OPEB related liabilities. And all these, the activity here and the numbers here are really dealing with actuarial calculations of the net pension liability changes. And there's associated deferred inflow and outflow changes for pension calculations. I did get a question. Thank you, Beth. So the question just came in is, it's about future liabilities for environmental obligations. If there is a law that is passed but not yet implemented, which has an estimated possible future fine, that would be excluded from governmental fund but included in governmental wide. That is a bit of a tricky one for I guess for two reasons. Well, I guess my general answer, well, let me read it again, make sure everyone is following this. So it's about environmental obligations. So the law is passed, and actually rereading it will help me answer this too. There's a law that's passed. No, I get where you're coming from, and I've actually dealt with this before. And it could be a little tricky, but so a law is passed but not yet implemented, which is going to estimate a future, or it's going to affect a future cost. Would that be excluded from governmental funds, but included in governmental wide? It would be excluded from governmental funds, but what I don't know off the bat is it gets a little tricky of the timeline of when that obligation goes into effect. And I wouldn't want to give you the wrong answer without doing the research, but um, we need to be cognizant of when that fine goes into effect. So I think, and don't quote me on it, if the law passed, but it's not yet effective, that you would not yet accrue that in your financial statements. That's my off the cuff answer on that. But I would call, if I was your auditor, I would call a lifeline before. I would definitely do some research on that before I gave you a definitive answer. But you got to be you definitely want to be aware of the triggering what's the trigger for the expenditure recognition. But I would think that if the law passed, but it's not yet effective, and it's been a while since I've had to deal with this, that's why I'm a little rusty on the answer. I think that if it's not yet effective, meaning like as of June 30th, if you don't owe it because it's not implemented, that you wouldn't have to record it. But that would most likely be a entity-wide liability. But there's some tentacles on that would have to be vet it out. But I definitely like that question. So I'm sorry I couldn't answer it definitively, but that's a I'm sorry you're in that situation or your government's in that situation, but that's an interesting one to research. And two, I guess you'd also have to consider is like how is it something that because there's other some of the other items I've seen with, and this might be just going down a rabbit hole that's doesn't apply here, but with environmental obligations, there isn't always one answer because I've had clients that have had environmental obligations where maybe they thought at one point they were going to settle an issue this way, and then they decided, oh, well, we could instead of maybe fully cleaning up the issue, we could maintain it and monitor it, and then that's changed the way that you recognize the cost or the expenses with it. So there's things to evaluate. But I do appreciate the question. But that'd be a good research item. Um, but yeah, typically if there are environmental remediation liabilities, those are typically long-term liabilities. And again, the only way you would have a liability is like on your general fund financial statements is if you had some work done and you actually got an invoice and you are like, no, we have to pay for this remediation, or this is due and payable now with current resources, then yes, you have a liability. But if you didn't get an invoice, there's no requirement for that payment to be made, now, then that's most likely going to be a long-term liability or an entity-wide liability. Very good. So let's go back to the slides. So I mentioned the term due and payable. So that's also mentioned if you have the book, it's mentioned in section 10 or on page 10-5. So again, when it summarizes the types of exceptions that we talked about, the compensated absence exception, the pollution remediation exception. So it's saying no expenditure should be recognized in a governmental fund in connection with any of these specific items until the related liability becomes due and payable. Okay. So due and payable. In the case, and I think I touched on this, but it says in the book, in the case of vacation leave, the amount to be accrued as an expenditure is expressly limited to pending payouts of unused leave owed to employees who have left active service by the end of the fiscal year. So when I gave that example of, I retired at the end of the year, that's going to trigger a payment to me. That is considered due and payable. That is a governmental fund liability. And I've seen governments from time to time offer, early incentive payout. Maybe they want to reduce their payroll expense going into the next year. A whole bunch of people retire or take that incentive package at or before fiscal year end. The payment hasn't been liquidated yet, so that creates a general fund liability and expenditure recognition because now those liability, those employees have ended their service, and that's the triggering event for these leave payouts. So those long-term liabilities can get converted to fund level liabilities. But again, the key here is due and payable. So there's an exception. I touched very briefly on pension and OPEB. I think pension and OPEB is discussed in a little bit more detail. That'll be in the third day of the seminar coming up, probably in the other specialized application chapter. So, but if you have pension OPEB questions, by all means, feel free to throw those in the chat. But there is an exception for pension and OPEB. The book says many governments offer pension and OPEB benefits, or OPEB. I guess that's redundant if I say OPEB benefits. OPEB to their employees in a defined benefit plan. It's making a distinction here of defined benefit plans versus defined contribution plans. So in a defined benefit plan, a government commits to providing its employees with a specified level of future benefits. In a defined contribution plan, a government employer commits to making ongoing contributions to individual employee accounts during the employee's active years of services. Sometimes the government sponsors their own DB plan for short, defined benefit plan, defined benefit pension or OPEB plans. At other times, the government may choose to participate in a multiple employer plan, like the state of Maryland pension system, for example. Some multiple employer plans are essentially a conglomerate of individual plans whose management has been outsourced. So it's just going into all the different types of plans. I won't go through the nature of all the different types of plans. Okay, here it goes. So in chapter 20 is where it goes deeper into pension and OPEB items. So I think you'll get that in the next day that you've got the training. But it does talk a little bit more about defined benefit plans, government employers that participate in a single employer, agent multiple employer, or cost sharing multiple employer defined benefit plan would recognize. So what would we recognize in the governmental funds? An expenditure for pension benefits and OPEB benefits for the total of contributions made by the employer during the period. So that would be basically if the government made contributions into the plan, right? That's going into whether it's a government sponsored plan through a fiduciary trust or whatever. If the general fund's cutting a check for contributions, that's going to be a governmental fund expenditure. That's one example. And the other example, the amount of change in the amount of change in the amount reported as a fund liability by the employer to the pension OPEB plan. But generally speaking, there's no fund level liability transfer. So I don't know where I haven't not seen that one in practice. But generally, the contributions that are expensed, the employer contributions, that's a governmental fund expenditure. All the calculations with net pension liability changes, deferred inflow, deferred outflow changes, all entity-wide, has nothing to do with the governmental fund or the general fund financial statements. So it further goes on to say, for government employers that participate in cost sharing, multiple employer defined benefit plans, an expenditure must be recognized for all contributions related to payroll for the period, regardless of when they come due, regardless when payment is expected. For defined contribution plans, government employers that participate in single employer, agent multiple employer, or cost sharing plans would also recognize an expenditure for pension or OPEB benefits for the sum of the contributions made during the year plus the amount of changes in the fund liability. So basically, whatever checks you cut into the plan are going to be expensed. So the short answer here is that there's really no. You could have a lease where there's scheduled rent increases, which don't impact this was superseded. Actually, you know what? This is an old point. This was amended with GASB 87. So I'm going to ignore that point. That's GASB 87 took care of this one. And then lastly, there's an exemption for prepaids, insurance, and similar services often are paid in advance for multiple periods. Under the accrual basis of accounting, the proportion amount of expense must be recognized in each of the period benefiting, right? So you have a prepaid, you kind of have to amortize it over the months or the periods that the payment covers. In contrast, under the modified accrual basis of accounting, governments may recognize the entire amount of the prepayment as an expenditure of the period that the payment is made, or proportionately over the periods that the service is provided, which essentially is saying we have an option to record prepaids and amortize them or just expense them as the payments are made. So there's an option here to expense your prepaids or capitalize them, if you will, and then amortize them over the period. All right, that takes us through chapter 10. All right, I had mentioned a little bit about other financing sources and uses, or at least and just to give you the picture of where they go geographically in the financial statements. So again, still on the governmental fund financial statements, other financing sources and uses are reported on the statement of revenues, expenditures, and changes in fund balance. They're reported below revenues, below the expenses. And you see down here other financing sources and uses. A source being another financing source is basically an inflow that's increasing fund balance. We don't call them revenues. They're technically not revenues, but they're a credit balance and they're increasing fund balance of whatever fund has the other financing source. Conversely, the use is basically an outflow, or a resulting in the decrease or the use in fund balance. They're not expenditures, but they have an effect that they're a debit. They're a debit balance. And GASB will specifically define what activity qualifies as an other financing source or use. All right, so we talked earlier about government funds focusing on near-term liquidity, right? We're on the current financial resources model, so we're not, again, this is the blend between cash and accrual basis. So we're not fully accrual, we're not fully accrual, we're not fully cash. So this is kind of a side effect of this near-term liquidity that we focus on, or the resulting accounting recognition of modified accrual accounting. So most of the increases most of the increases in current financial resources, or another way to say it, fund balance, most of those increases are considered revenues. Most of the decreases in net current financial resources are expenditures. Generating spendable resources through borrowings, however, clearly is a quite different matter. So, right, revenues are what? We talked about revenues as far as derived tax revenues, and revenue was defined earlier in one of the earlier chapters. But what do we call the issuance of debt? Is the issuance of debt a revenue? No. So the book's explaining that generating spendable resources, because issuing debt results in cash, an influx of cash, and it results in an increase in fund balance. So generating spendable resources through borrowings is a different matter than generating spendable resources through taxes or fees or even grants. Likewise, transferring resources from one fund to another is not equivalent to actually expending those resources. Accordingly, authoritative accounting standards carefully distinguish revenues from other financing sources. We'll call them non-revenue, right? Other financing sources. And it's careful to distinguish expenditures from other financing uses. So authoritative accounting literature has identified the only instances when it is appropriate to use other financing sources and uses, and they are limited to the following. Let's see if I have it summarized here. Here we go. It's on the screen here, but also if you've got the book, it's in the chart on 12-2. So other financing sources, this is, again, again, inflows or increases to fund balance. And again, the issuance of long-term debt, and that would be both the face amount and the premium. So that GASB's allowed that, or requires that, I should say, to be reported as in other financing sources. Inception of a capital lease, which now that, with GASB 87, it's really just a lease now. We don't call it a capital lease, but inception of a lease would be an other financing source. Debt service on demand bonds that are reported as fund liabilities. I don't see that very often, but that is, oops, I'm just trying to get to the bottom of the chat, make sure in case anyone types in any questions. So debt service on a demand bond. Sale of capital assets. So these would be the proceeds, really, right? The proceeds of the sale of capital assets. Insurance recoveries and transfers from other funds. So one fund transferred cash out from one fund, but it's coming into another fund. It's a other financing source. And then, so those are the inflows. The examples of the outflows or the other financing uses would be if, the inverse of a premium, if there's a discount on the debt, because the debt is going to be reported at face value. So the other financing source would be the face value of the debt. But if that debt was issued at a discount, then you would have an other financing use to report. I think most debt, I don't know the last time I saw debt issued at a discount. A lot of times you see the premium, but keep in mind the face value of the debt is recorded in the other financing sources, and the premium or discount is shown separately. So the first example, again, here, other financing uses, original issue, discount on debt. If there's debt refunding, so payments to advance or current refundings to escrow agent. So that refunding transaction would go through other financing uses. Again, the demand bonds, I don't know if I've ever seen that in my career, but reclassification of demand bonds as fund liabilities and then transfers to other funds. So I would say transfer is very common to see in other financing uses. Refunding or payments for advance refunding, very common. So it's got to fit into one of these categories to be considered other financing sources and other financing uses. The book's going to go through some journal entries. I'm not going to spend too much time on entries. Just want to looking ahead to other categories. I want to make sure I get to it. Okay. But if you've got the book, it's just showing that some entries here. But if debt's issued, essentially it's a debit to cash and a credit for other financing sources, issuance of debt. So, the example here in the book is $100 of debt issued. You'd have a debit to cash for 100, where you're going to see that show up in the financial statements for the credit side, other financing sources, issuance of debt. So here it would go down somewhere here. They had, in the sample here, they issued some special in our sample set of statements here. The Capital Project Fund was the recipient of $4.7 million of special assessment bonds. And again, that's the face value of it. So I know the debit wouldn't quite be the 4.7 because it was issued at a discount, but essentially you're debiting cash for the cash received, crediting other financing sources for the bond that was issued, but then also having a discount or basically a debit to book, if you will, for $10,000 for the discount on the special assessment debt. So the journal entries, aside from dealing with the premium or discount, debit, cash, credit, other financing sources, debt issuance. It goes on to show some journal entries if there's bond issuance cost. So bond issuance cost. Although the debt issuance goes down here as other financing sources and uses, any bond issuance cost goes up here in expenditure. So you see here is issuance cost here. So it's a little bit of it's not necessarily all bond and debt related activity goes in other financing sources. It's the issuance of the bond. But I think it's a little bit interesting is, if you issue debt today, you're going to get the proceeds down here in the other financing sources. Then you're going to spend the money, right? Probably on capital activity. So then the expenses go up here into capital outlays when you're spending the money. And then as you make debt service payments on the debt, that also goes up here in expenditures. So the spending of the proceeds is going to be in the expenditure section. The principal and the interest related to the repayment of the proceeds goes into the expenditure section. But what goes down into other financing sources and uses is the issuance and the proceeds, or if there's refunding of bonds. So it's a little interesting about how there's differences in the types of debt or bond activity and where that shows in the financial statements. So in the book, let's get back on track here. There's just more journal entries mentioned on 11-3, but that's why I bring up the point about bond. It talks about bond issuance costs or the discount and the premium. So those are just all shown on journal entry format here. And then on 11-4, it talks about long-term borrowings within the primary government. So there could be funds that are borrowing from other funds. That's going to be a little bit of a unique caveat that you may experience. So governmental funds treat long-term loans from other funds of the primary government as a liability rather than as an other financing source, therefore eliminating the possibility of using internal loans to manipulate the level of fund balance in the borrower fund. So again, governmental funds treat long-term loans between funds. So the fund that's borrowing the money is going to report a liability. The fund that's lending the money is going to report a receivable, rather than having that go through other financing sources as a way to not manipulate fund balance. So keep that in mind. Now, if the fund decides to say there is a long-term loan that ends up, maybe the fund can't repay it, that could be settled through a transfer. So the decision could be made to say, Fund A is no longer going to be required to pay Fund B because it can't, or whatever the decision is made for that. Then that could be resolved through a transfer. But if the decision is that no, Fund A needs to refund or pay that loan to Fund B, it's going to sit on the balance sheets of those funds as a liability and a receivable. So we don't get the benefit of the influx or the decrease of the fund balance when their loans are made between funds. They also talk a little bit about no commitment special assessment debt. Sometimes governments issue special assessment debt that will be paid back entirely by the benefiting property owner and for which the government itself is not obligated in any manner. Accounting and financial reporting emphasize economic substance over legal form. From that perspective, debt that does not have to be repaid is not really debt at all. Accordingly, the proceeds of no commitment special assessment debt are properly classified as revenue rather than other financing sources. Viewed another way, a capital type special assessment for which the government is not obligated in any way, in any manner, is essentially a grant to the government from the property owners who pay to construct a capital asset that will ultimately belong to the government, much like road construction funded by a higher level of government. So again, I don't know how often I see no commitment special assessment debt, but there's just keep in mind that if you do come across that transaction or that situation, that there is a little bit of a difference there from the accounting perspective that's different from the traditional issuance of debt. The issuance of a lease, so that value of the lease that's issued does get captured as an other financing source. So if you enter into, what used to be called a capital lease, now just basically a lease that qualifies under GASB 87, you've got a calculation that would say, here's the value of the lease, and you've got basically you're going to recognize an inflow and an outflow for the issuance of a lease. But that's all covered under GASB 87, so I'm not going to go into the requirements there, but just keep in mind other financing sources and issuance of a lease or inception of a lease does impact other financing sources. I'm just checking. All right, no questions there. Debt service on demand bonds reported as fund liabilities. Governments also often retain a right to redeem debt prior to the maturity. That's a call option. Less frequently, bondholders retain the right to demand repayment in advance. That's called a put option. Bonds that contain the latter option, or the put option here, are sometimes referred to as demand bonds. Because there is a risk that demand bonds might have to be redeemed much earlier than planned, they must be reported as fund liabilities in governmental funds unless they meet the criteria that eliminate any possibility that the government has to provide resources for their repayment within 1 year of the end of the period. So I don't know how often I've seen demand bonds. It's pretty rare, but keep in mind that there could be a situation where the bondholders retain the right to demand repayment in advance, also known as a put option, and that could then require these bonds to be reported as fund liabilities instead of other financing sources. So, and then they show some of the journal entries associated with that. Sale of capital assets. Governments routinely dispose of surplus capital assets. In most cases, the proceeds from disposals are relatively insignificant. So keep in mind there's a little bit of an decision making or judgment call we have on the classification of sale of capital assets. So if the sale of capital assets is relatively insignificant, the proceeds of the sale are properly classified simply as other revenue. So if you have immaterial sales or proceeds from capital assets, that can be classified as other revenue. However, if the proceeds from the sale of capital assets are considered to be significant, they should be classified as other financing sources rather than revenue. But we do have some judgment there that we can make between the proceeds from the sale being other revenue versus other financing sources. So similar concept with insurance recoveries. The ordinary sale of a capital asset is really just the conversion of a non-financial asset into a financial asset. The same might be said of insurance recoveries, which are sometimes described as involuntary conversions. Accordingly, the rule just described for sale of capital assets holds true as well for insurance recoveries, which should be reported as other financing sources if significant. Again, so that's if significant. Furthermore, on 18-8, Transfer from other funds. So again, these are transfers between funds. A transfer from another fund is always reported as an other financing source. Transfers normally are easy to identify. There are three specific situations, however, where special care may be needed. So one is risk financing. If the general fund is used to report risk financing activities, premiums received from other funds in excess of expenditures and liabilities incurred must be reported as a transfer or other financing source. Another situation you want to be aware of is interfund loans. Similarly, interfund loans from another fund for which repayment is not expected within a reasonable time must be recorded as a transfer. We talked uh, a little bit about this before, where I said that the loans between funds can't be used to inflate fund balance, so they would sit there as a receivable and a liability. But if it's determined that that repayment is not expected to occur, and they're saying here within a reasonable time, there should be a transfer made. That way, there's not a bad transaction sitting on the balance sheet between two different funds. So if it's determined that that loan will not be repaid, go ahead and make the transfer to clean it up off the balance sheets. The third situation to be aware of is payment in lieu of taxes. Sometimes payments in lieu of taxes occur within the primary government, i.e., payment from an enterprise fund to the general fund. If so, they normally are properly reported as transfers. However, if the amounts paid are in fact reasonably equivalent to the value of the services provided, meaning it's, an exchange or exchange like, the recipient fund should report revenue. So I think those are the three caveats for transfer related activity: risk financing, which I don't see a lot; interfund loan, which I do see that from time to time, where a loan's been entered into between funds, but the fund that owes the money isn't able to pay it back, and sometimes they sit on the balance sheet for what seems like an abnormally long time. And if these loans are not expected to be repaid within a reasonable timeline, they should be transferred out. And then thirdly, payment in lieu of taxes. So we're almost through chapter 11. It elaborates a little bit more on the other financing uses side, the original issue discount of debt. Um, I don't think there's really much to elaborate on that, but just keep in mind where that was sitting on our sample financial statements here is that we've got the face value here. Um, that's the face value, but that's not the cash that was received because of the discount, and that discount is shown here as a outflow or a use of fund balance, if you will, in the other financing uses section. Payments to advance refunding escrow agents. So here it's saying governments sometimes elect to issue refunding debt before they are actually able to redeem the refunded debt. In those circumstances, the proceeds of the refunding debt are placed into escrow for the future repayment of the refunded debt. Any portion of the proceeds of refunding bonds thus placed into escrow is properly classified as an other financing use. Then we talked about, again, I don't see the demand bonds as fund liabilities very often, but keep in mind that if there is a demand bond transaction that's sitting on the balance sheet as a liability and initially not going through other financing sources and uses, but so the book says demand bonds are presumed to be fund liabilities unless they meet certain criteria that eliminate any possibility of the government having to provide resources for repayment within 1 year of the reporting period. It is entirely possible that demand bonds that originally met the criteria to be a liability on the balance sheet will fail to do so in a later period. So in that case, if it met initially, it was reported as a liability, but later no longer met that criteria, it would be reclassified from a fund level liability and then go through other financing uses. And then lastly, it talks about transfers to other funds, which is very similar to what we talked about with transfers from other funds, just that being the other side of the transaction. Okay, so any questions on chapter 11? So we have three more chapters to go. I think so. We've got assets and liability recognition in the governmental fund statements. I think this chapter I'll go pretty quickly on. I do want to spend a little time on chapter 13, which is the governmental fund financial statements and introduces some additional concepts regarding the financial statements. So I want to cover that. And then last but not least, and I think you guys have already heard a bit about proprietary funds. So I won't spend a lot of time on that, but that's the last chapter for today. So I'm thinking it's almost 4. Why don't we do this? Let's take just I'd like a 5-minute break just to get some more water, just rest my voice for a second. Let's take 5 minutes. Um, we'll come back let's make it, I know it's I'll make it 3:58. That way I'll get you guys out of here a little bit, so I won't take that long of a break. Let's just take 5 minutes. Let's come back at 3:58. We'll go through the last 3 chapters, and I would project that would put us close to say 4:30-ish or so for a wrap-up time. So let's just take a 5-minute break, and then we'll pick back up and get us through we'll get through the rest of the chapters in the day. So let's meet back at 3:58. Okay, guys? On chapter 12, we've got 3 chapters left. I appreciate you letting me take a small break there. I think I'll be able to get us out of here in roughly 30 minutes. But please, if there's questions, feel free to still put those in the chat or we can discuss those. But what I'll go through is probably go through chapter 12 a little bit, kind of quick, and then spend more time on chapter 13. So chapter 12, we've spent the previous chapters talking about expense, or I should say expenditure recognition, revenue recognition, which a lot of those items, because transactions have to balance, right? Debits have to equal credits, so the other side of the transaction is going to be on the balance sheet. Some of this stuff we kind of inherently talked about, but there are some additional caveats I think worth noting for asset and liability recognition. So I'll just pick out what I think are some of the more significant items you should be aware of for asset and liability recognition. Some of this stuff deals with very unique situations, so I won't spend much, if any, time on very rare situations. Just keep in mind that there is, if you do have an endowment, just keep in mind that there could potentially, well, I wouldn't even say there could potentially, but like if you're expecting a receipt from an endowment, there's typically no receivable book for that. So just some items I might just pinpoint to keep in mind. So governmental fund assets. So let's start with that. So governments report cash, which I think we kind of know what that is, but it's defining as currency on hand. That's demand deposits with banks or other financial institutions, and deposits in other kinds of accounts or pools that have the general characteristics of demand deposits. So I don't think that's earth-shattering that cash is reported on the financial statements. We also have investments. An investment is defined as a security or other asset that a government holds primarily for the purpose of income or profit, and has a present service capacity based solely on its ability to generate cash or to be sold to generate cash. So investments also meet the definition to be reported as assets. It goes on to talk about receivables for property taxes, and we already talked about revenue recognition and receivable recognition for property taxes. So I'm not going to go into that in really any detail. I think we already hit on that. Uh, One interesting caveat, I have seen this from time to time, but there could be a situation where there's a receivable for debt proceeds. This one's a little interesting. When a government issues bonds, there may be a brief period between the closing date and the receipt of the proceeds being the settlement date. So a gap between closing date and settlement date. So the debt is, pardon me. Um, Accounting standards require that the debt be recognized as of the former date, meaning it's at the closing date. Accordingly, if the debt has been issued as of the reporting date, but the proceeds have not yet been received, a receivable should be recognized in the amount of the proceeds that will be received. So that can happen. Just keep that in mind, especially if you're issuing debt really close to year end. Recorded at the closing date, the debt at the closing date, but the cash may not have been received yet. Receivable for a guaranteed deficit. I don't see that very often. I'm going to skip that. Receivable for unallowed costs. This is really related to a grantee. If a grantee spent money on unallowable costs, then that amount's expected to be recovered by the provider government. Just again, that's a very unique situation you don't see very often, but that can qualify or does qualify as a receivable. If there's a pending contribution that a government's expecting to an endowment, that's not a receivable. Typically, you're expecting the receipt of the actual cash receipt is triggering the eligibility. So then there's not a receivable for endowment proceeds. Lease receivables qualify if anyone's gone through the implementation of GASB 87 and has a lease receivable. That meets the criteria to be recognized on the governmental fund financial statements. We're not going to go into the details of GASB 87. Inventory can be reported. Again, I'm not going to go through these items, but if there's capitalization contributions to public entity risk pools, which I probably could count on, I don't even think I've seen that before. I was going to say I can count that on one hand. I don't even think I need one hand to count how few times I've ever seen a capitalization contribution to a public entity risk pool, but that would be an asset. Investments in joint ventures are reported as assets only to the extent that there is an explicit measurable interest. Assets acquired for sale. So governmental funds do not report property, plant, and equipment because those assets are normally used in operations and therefore will never be available for spending. However, specific items of property, plant, and equipment occasionally are acquired with the intent of sale, meaning they qualify as financial assets because they will convert to cash in due course. The most common example are foreclosed properties, redevelopment properties, and donated assets held for sale rather than retained for use of operations. And there's further discussion there on the types of properties that were just mentioned. So let's get through. And here, so you'll see that on the slide deck too. Foreclosed properties recorded as properties held for sale in an amount as what is expected to be collected. Redevelopment properties recorded at amount ultimately expected to be sold for. Donated assets held for sale typically. So donated assets held for sale typically not recorded until the sale contract has been signed prior to the issuance of the financial statements. But just be careful of recording donated assets on the balance sheet. So that's got to be pretty far along in the recognition process. So that's why it's typically not recorded until there's a sales contract. All right, what do we got? Governmental fund liabilities. And I hit on actually a number of these governmental fund liabilities when I talked about the expense versus the expenditure recognition and how claims and judgments don't get recognized as fund liabilities unless it's due and payable. Compensated absences, there has to be a separation. So it's a little redundant on what I talked about there. So I'm not going to go through each one of these items for fund level liabilities. But as I kind of rush through that chapter, because I want to get through 13, I don't want to skip anything. If anyone had anything you wanted me to touch on, are you guys good for me to move on to the next chapter? I'm going to take silence as a yes. All right. All right. Thank you, Beth. Thank you, Karen. So chapter 13. Again, I'm a nerd for the financial statement, so I like this chapter. I mean, it touches on a few topics related to the financial statement. So, all right, first item that we're going to talk about is major funds. So, what's a major fund? I think you guys talked this morning about fund accounting. So you understand a fund basically gets it's activities reported together that balance. You've got a balance sheet, you've got the statement of revenues and expenses, and you're recording and balancing all that activity in a certain fund. How that fund appears in the financial statements is a column here. So in our governmental fund financial statements, the general fund is a fund. It's got a name and a column. So I think that's pretty self-explanatory, right? But there's a contrast between major funds and non-major funds. So what are the requirements here between major funds and non-major funds? By definition, the government's main operating fund, the general fund, is always classified and presented separately as a major fund. So the general fund, by default, is a major fund. So that's requirement number one. The purpose of major fund reporting is to ensure that each of a government's most important funds is reported separately, right? So if you see here, what's being reported separately on this statement? General, community development block grant, capital projects, debt service. These are considered major funds because they're identified within their own column. Total non-major funds here is a combination of other funds that are not presented separately here. So there's a combining schedule in the back of the statements that are going to separately identify those non-major funds. And the summation of those funds equal the total non-major fund column here. But what makes those non-major, and we'll get into that in a second, is that, well, one is the idea is too many columns on the financial statements really would make the statements hard to read. The font would be too small. So the idea is that the statements can be legible, that, a government may have one fund, it may have 50 funds. Every government has a different footprint of what their funds look like. And that's why we get into non-major funds and these combining schedules, because if they meet the criteria, which essentially is driven by the size of the fund, if they're s- in, if they're smaller, and I'll define that here in a second, but if they qualify as a smaller fund, then we have the option here to show them as non-major. And I know I'm shooting from the hip a little bit with these comments, but I'm just speaking what comes to my mind. But a fund that does meet the definition of a non-major fund, meaning it's falls below the relative size criteria we're going to talk about in a minute, a government has the option to make a non-major fund major. So you have the discretion to say, although we have this small fund that we could put in the back, we want to show it up in the front for some reason. We want more focus on it. It's important to us. The users care about this fund, whatever. You have the option to make a non-major fund major and show it up here. But conversely, GASB doesn't allow the opposite, where you can't, if the capital project fund meets the dollar thresholds we're going to talk about to be major, you cannot elect to make a major fund non-major. So you can't push a fund to the back or to the combining schedule, or combining column, I should say, if it meets the major fund criteria. Okay. The book says that the purpose of major fund reporting is to ensure that each of a government's most important funds is reported separately. Relative size, and we'll get into that, these are calculations. Relative size can make a given fund important to financial statement users, as can qualitative factors independent of size. So let's go back. Do something here, sorry. Okay. So when we talk about relative size, we're going to have to do a calculation. And it's based on four financial statement elements that we're going to have to run this calculation on. It's assets, now if there are any, plus deferred outflows of resources, which governmental funds very rarely have. Now, but keep in mind that even though we're talking about governmental fund financial statements, the governmental fund financial statements we're talking about, this does apply to enterprise fund financial statements as well. You're doing this for your enterprise fund and your governmental fund financials. Beth, I see you have a comment here about in the GASB 103 trainings, it has been recommended to redo the major fund calculation just to make sure the change in operating subsidies doesn't change the designations. That's a good point as you guys implement. Thank you, Beth. As you guys are implementing GASB 103, and I know that's not a subject for today, but there could be some geographical changes within your proprietary fund financial statements related to GASB's now defined non-operating revenues and expenses, as opposed to what they previously had done is defined operating revenues and expenses, and whatever doesn't fall into that definition would be non-operating. There might be some geographical changes in your enterprise funds. Keep that in mind. You may want to rerun. It's a good scenario to do anyway. Just, I would say, annually look at your calculations here, especially if you're submitting it. I know this is a GASB requirement. No, and that's a great thought, Beth. Um, but especially if you're submitting your financial statements for the GFOA award, you could have a fund that one year meets the non-major criteria. You might have a grant fund that had very little activity, but then one year have a substantial amount of expenses or revenue. And you don't want to miss it that, okay, every year this fund's been non-major and now all of a sudden it met the major fund criteria. It's good to dust off this calculation on an annual basis. So the criteria here is and again, you're doing this for enterprise funds and you're doing it for governmental funds. So you're taking four financial statement elements, the assets plus deferred outflow of resources. You're doing that for all your funds and you're calculating that across all funds. That's financial statement element one. The second element would be the liabilities plus deferred inflow of resources. Again, you may or may not have deferred inflow or outflow, but deferred outflows are naturally a debit, so we're going to group those with the assets. The deferred inflow of resources is naturally a credit. We're going to group that in with our liabilities. Then our revenues and our expenditures slash expenses. So there's four numbers you're calculating, and you're looking at that across all funds. And if you've got the book, they've showed the criteria or the percentages here now in Exhibit 13-1. So once you get those four financial statement elements, you have a two-part test. So here, 2 points of reference. Does the fund, and let's just assume it's a governmental fund. So check number one. Does that governmental fund any one of the four categories? It's not all four categories, it's any one. Does any one of the four categories listed up here as the assets, liabilities, etc., do any one of those four categories for the potential major fund, is it more than 10% of the total of all governmental funds? So if you had a grants fund that's $5 million of assets, and the total of all governmental fund assets is $45 million. Well, the answer to that is yes, that, 5 million is more than 10% of 45 million. I'm assuming I'm doing math correctly, but I'm doing it in my head, so it's a little dangerous. But that grant fund, okay, $5 million of assets against 45 million across all governmental funds. Yes, that qualifies. But that's not the only test there. Then you have to look at governmental funds plus enterprise funds and then compare the same number there. So if we were looking at a grant fund that met the criteria for assets, now you have to look at that same criteria still with the assets to say, is it more than 5% of the total between governmental plus enterprise funds? Now, what happens here a lot is I would say no if I was a betting person, because if the government does have enterprise funds, and keep in mind in your enterprise funds, you have the fixed assets, the value of fixed assets is on those enterprise fund statements. So if we're at 45 million, if this fund has $5 million in assets, 45 million in the governmental, it just barely met the 10% criteria. There's a decent shot it's going to fail the 5% when you combine governmental plus enterprise. But if it didn't fail it and it met both the 10% and the 5%, now that grant fund is required to be reported as a major fund, and GASB does not allow an option for that to be reported as non-major. And keep in mind, it has to pass both the 10% and the 5% calculation related to the same financial statement line item. So in my example with the grants fund, it doesn't matter if it met the criteria for governmental fund, the 10% test for assets, it failed the asset test when you factor in enterprise funds, but let's just say somehow it met it for revenues. Well, it has to line up with the same financial statement line item for both checks, if that makes sense. If it fails the test, as a government, you have the option, like I said before, to make the non-major fund major. But if it passes the test for major, you don't have the option to make it non-major. The downside is when something was non-major and now it's major, you have geographical formatting you have to deal with in your financial statements. And I know that can be a little bit annoying. But just keep that in mind. Again, I would suggest looking at that on an annual basis to best point with the implementation of GASB 103 if that's impacting your subsidies and your non-operating activity. Keep that in mind also. Any questions there? So there's a bunch of pages that go through the mathematical calculation, and I'm definitely not going to run through math at almost 4:30 in the day. So that's just some light reading if you want to look at the calculations there. Just one other caveat too. If you make a non-major fund major, it is a good idea to put non-major on top so that way you know that, okay, it's presented as major, but it's still, or you could just say, well, if you had two funds and there's no sense to have a combining, what are you going to combine? There's nothing to combine and then report in the back of the statements with more. It's not like you have to, if you had two funds and the other fund's non-major, you have to have like now a combining schedule in the back of the statements. You just report both columns here on the balance sheet and you just write non-major above the fund that technically is non-major. When you have too many funds to list, you combine them here and you have a combining schedule in the back that details them out so that a user still knows what the funds are, what the balances are, and the activity. The non-major fund, the benefit to the non-major fund is just so that this statement is still legible and fits all on one page. Okay. Another concept I want to talk about a little bit. Let's see how many more concepts. I just want to see how much more of chapter 13 I've got to talk about. I probably got you all excited that I'd be done by 4:30, so I want to try to live up to that. All right. Okay, here. I want to talk about governmental fund financial statements. There's 5 potential categories of fund balance. And, if we go back to our sample here, just to give you the visual. 1, 2, 3. Okay, good. They have all 5 here. We've got non-spendable, and we'll define all these in a second. So again, this is only governmental fund financial statements. This is irrelevant to your enterprise funds. This is irrelevant to the entity-wide financial statements. This is only with our governmental funds. There's 5 potential components of fund balance, and they go from kind of most restrictive to least restrictive, if I can use that term. But it goes from non-spendable, which means you can't spend the amount, restricted, committed, assigned, unassigned. Those are the only 5 categories you can have. Doesn't mean you have to have all of them, but that's the population that we're dealing with here, 5. Since we're looking at this now, it's not required on the face here to go into this level of detail because, it does make the balance sheet very long. That like half of the sheet is fund balance categories. It's not uncommon to have just the 5 categories listed here with the totals and then a footnote in the back that would then go at this level. So I don't want you to think you have to be this robust on the face of the statements. This level of detail is not required at this level, but if you do summarize and just have totals, I would suggest a footnote that elaborates that. Um, let's go back to the slide. So we'll talk a little bit about the definitions here. So if you've got the book, this starts on around 13-8. Well, I guess just to take a step back, fund balance is what? The term fund balance is limited to governmental funds where it is used to describe the difference between a fund's assets plus deferred outflows minus, liabilities and deferred inflows. Government funds report up to 5 different components that are designed to indicate both constraints on how the resources can be spent and the resource of those constraints. The various components of fund balance are presented in descending order from most constraining. I said the term restricted. I guess technically that's not right because restricted is one of the categories. So it's really from most constraining to least constraining. And that's on the slide here. That's listed from most constraining to least constraining. First, we have non-spendable. So some of the resources reported in a governmental fund cannot be spent because they are not in spendable form. So what does non-spendable form mean? Some resources cannot ever be spent because of their form, such as supplies, inventory, or prepaid items. So if you have supplies sitting on the balance sheet, the money's already been spent. The inventory just hasn't been consumed. So conceptually, you can't spend inventory. The prepaid, right? The money has already been spent. The prepaid just hasn't been consumed. It hasn't been amortized. So a prepaid is not in a spendable form. So they've defined supplies, inventory and prepaids as not in spendable form. Furthermore, there's also a caveat with long-term portion of loans receivable not being in a spendable form. So GASB is specifically defining what are the assets that are not considered spendable and therefore should be included in the non-spendable form. So aside from not in spendable form, there is an element of legally or contractually required to be maintained intact. And that would be another example of a non-spendable form. So getting into restricted fund balance, some constraints on the use of resources are externally enforceable. Okay. Resources subject to such constraints are reflected in restricted fund balance. Most restrictions are imposed by parties outside of the government. Okay. Committed fund balance. So again, restricted fund balance is really driven outside the government's control. Externally enforceable. Committed fund balance, now we're getting to within the government. There's no external forces at play here. But what is? Committed fund balance, that's where a government at its highest level of decision-making authority, the board, the council, governance, right, may formally place a constraint on the use of its own resources. So the government's has made this determination, but it's at highest level of decision-making authority. Okay? Then we get down to assigned. So governments frequently desire to set aside or earmark resources for a particular purpose. The resources thus set aside are reflected in assigned fund balance. So who can commit fund balance? Well, I guess what it's saying here is the difference between assigned and committed really has to do with the who, the how, and the when. So for a committed, it has to be at the highest level decision-making authority, whereas for assigned, it can be delegated to a group or individual that's determining assigned fund balance. So essentially, it's management. And To summarize it in a word, management can assign fund balance. Management cannot, unless management's the highest level of decision making. Management is typically not committing fund balance. How? Committed fund balance requires formal action, whereas there really is no formality required in assignment. It's really based upon intention. There's a very low threshold to assign fund balance, whereas committed, there must be formal action. When formal action must be needed to commit fund balance before the end of the or by the end of the reporting period, which assigned fund balance can even happen after year end. So there's a time element there. Then last but not least, anything that doesn't fit into any of these four categories is going to be the residual amount. And that's your unassigned. So anything that's not assigned, committed, restricted, non-spendable is assigned. I'll make one more point on fund balance, that the general fund is the only fund that can have a positive unassigned fund balance, because in theory, every other fund has a purpose. So it's the funds are intended for the purpose of the fund. So another fund cannot have an unassigned positive fund balance. However, a fund that goes into a deficit would or must report a negative unassigned, because you can't report a negative assignment. You can't assign what you don't have, right? So in this case, the capital project fund is in a deficit because one is liabilities are greater than assets. Secondly, there's a commitment on top of that, which further makes the unassigned deficit greater. So keep in mind, general fund, only fund that should have a positive unassigned. If you ever end up in a negative situation, the negative should show up in another fund. The negative should show up in unassigned. That's my comments on fund balance. The rest of the chapter talks about format. It talks about the budgetary comparison statement. I would be careful about over relying on what depending on the version you have. I don't know if the newest version of the Blue Book has GASB 103 implemented, but GASB 103 does have some impact on the budget, where now the budget is no longer allowed to be a basic statement. It must be in RSI section, and there's an additional variance column that's going to show not only the budget to actual, but the original budget to the final budget. So there's some changes in your budget that you're going to have to implement for GASB 103. Keep that in mind when you work on your financial statements for fiscal year 2026. Any questions there? And I think you've already gotten a lot of the information on proprietary fund financial statements. So this might just be a little bit um, out of order, kind of fitting in a proprietary fund chapter here. So I won't really go through this. Just keep in mind that your proprietary funds would have enterprise funds. That those are the funds that are charging services or charging fees to customers. The user charges are generating the revenue really for those funds. But internal service funds, the beneficiary is the government itself, and other funds are paying into internal service funds. The idea is that the internal service funds should break even over time. There's no requirement in any one year that internal service funds break even. But the idea being is that you do not want to build a huge surplus in the internal funds. I would definitely advise against having large deficits in internal service funds. Could that, not that I want to give you an incentive to mask anything, but that could, if there is having a large deficit in an internal service fund could be masking a general fund problem by putting it in an internal service fund that's got a large deficit. So that could have some negative ramifications from the public perception. Your auditor might bring that to your attention, could potentially impact, recommendations or the opinion if your internal service funds are not generating or not charging enough to the other funds to to cover the cost of services. GASB 103, to Beth's great point, take a look at that. That does redefine or really better define non-operating revenues. And there's now specific criteria to for the activity in non-operating revenues. And there's some definitions, excuse me, definitions. I'm really losing my voice now. Definitions of subsidies. And there's a distinction between capital subsidies, operating subsidies. So just keep in mind GASB 103 might have some impacts on those funds. So I'm sorry, I tried to keep it right at 4:30, went a little bit over, but I know technically I think all in we're still done a little bit early for the day. So I appreciate you all attending for today and sticking with me this afternoon. I appreciate, the observations and questions that you've provided. Thank you, Beth. Thank you, Sarah. Um, I hope everyone has a great evening. And if you have any questions, just jump it in the chat. Otherwise, you're all free to go and enjoy your evening. Thank you, everyone, for the kind feedback. Take
Thank
care,
you,
everybody.
Chris.
Yep. Thank you, Brianna. Bye.